Welcome to Acera's pre-retirement seminar. In this seminar, I'm going to tell you all the things that you might want to know in the 3 years leading up to retirement. Or for some of you, it might even be the 3 months leading up to retirement or the 3 weeks leading up to it, because the bottom line there is that you're going to retire soon, whether it's 3 years, 3 months, or 3 months or 3 weeks. And you probably have some questions forming in your brains, like, what do I need to do? And if I need to do anything, will you please tell me what it is? So I have arranged the answers to your questions in the form of this checklist that we're going to go through in the pre-retirement webinar. Okay, so this is going to prep you for retirement. The first topic we're going to talk about is I'll help you understand your Acera membership. I'll talk about contributions, retirement timeline, your tier. It's just good to kind of get a base of understanding of how Acera works, and that gives us context for the rest of the discussion. The next thing I'll talk about is I'll help you figure out how to estimate your retirement benefit, which is going to be what you are collecting every month for the rest of your life when you retire. We'll talk a little about the retirement formula that will help you understand how we calculate your retirement benefit. We'll talk briefly about considering purchasing service credit. I will talk about how vacation affects the salary component of the retirement formula, and we'll go into that. We'll take a deep dive into that. I will talk about our benefit estimator tool, which is how you get a precision estimate for your future retirement benefit. I will also help you verify your retirement eligibility. And we'll talk about choosing your retirement date, because it's going to be a date that you choose when you want to retire. We'll talk about the retirement application process and what it looks like and the 5 different retirement allowance options. I'll help you understand some other benefits, especially the medical, dental, vision benefits. And I will help you understand some other life events very briefly. And let's jump right in. Okay. Thanks for that comment. I'll try to make sure that you can follow along. Okay, first topic, understanding your Acera membership. Let's start at the beginning of the story. Who is Acera? In one sense, Acera is this acronym, the Alameda County Employees Retirement Association. But who really is Acera? Well, we at Acera, there's about 90 plus of us, maybe 93 of us. What we do, our entire job is to provide retirement, disability, and death benefits to our members. And you all are our members. So you are also part of Acera. You are also part of the who that is Acera. And you're a member of Acera because at some point you worked full-time. Perhaps you still work full-time, but at some point in the past you worked full-time in a retirement eligible position, and that automatically granted you membership in Acera. And the position that you work in is for one of these 6 public agencies in Alameda County that use Acera to provide retirement benefits to their employees, including Alameda County itself. As an Acera member, with every paycheck you have, you contribute to Acera's fund, and you'll see that on your paycheck. I think I don't have a screenshot of that. But if you look at the pre-tax deductions column on your paycheck, you'll see a little amount come out from every paycheck. It goes into Acera's fund, and your employer also contributes to the fund on your behalf every time you make a contribution, and they're usually contributing at a higher rate than you are. They're putting in more money. So we don't want that money to just sit around and stagnate and grow dust. So we invest it all over the world in a diverse array of investments with the goal of earning interest, which we do earn a lot of. And it's these 3 sources of income, the employee contributions, the employer contributions, and the investment earnings, that give us this big pot of money that we call Acera's fund. So why are we collecting this money? Why are we investing it? Why do we want to earn more money? What are we doing with it? Well, in answer to your question, you, meanwhile, are earning credit toward retirement while you work. Throughout your entire career, you're earning more and more and more credit. Then at some point, which it sounds like it's going to be coming up very soon for most of you because you're participating in the pre-retirement webinar, at some point in the future, you're going to retire. And this is when you stop earning your retirement and start collecting the retirement that you've earned. And you will collect it every month for the rest of your life. It's amazing. You cannot outlive your retirement. That check is just going to keep coming in every month on the last business day of the month, every month for the rest of your life. It's a secure retirement that you can count on, that is guaranteed to you because you earned it. And you earned it by earning credit toward retirement and by paying into the system and funding it through your deferred wages. Now, you'll see that it says retirement allowance here. I just want to throw out some more lingo real fast because I'll probably throw around different synonymous terms for this. I might say retirement allowance. I might say pension allowance. I might say pension benefit. I might say retirement benefit. I might say lifetime monthly allowance. All of those are synonyms for this same payment. It's your lifetime retirement allowance that you have earned. Let me show you some pension milestones, and this will help provide some context for a lot of the discussion that we're going to go through. So we'll talk about a lot of these. First off, and these are milestones that you will see through your career with and membership with Acera, and you've probably passed a lot of these milestones already since you're getting ready to retire. Excuse me. First milestone is your date of hire. This is your first day that they told you to show up to work in your full-time retirement eligible position. Now, if you started out in that position, this would probably be the first physical day you were at work. If you started out in some other capacity, like part-time or working on a project basis or something like that, this would be the first day in your full-time retirement eligible position. Now, you don't have to maintain full-time status after that. You just have to have achieved that full-time retirement eligible position, at least at the beginning. And that's what grants you the automatic membership in Acera. Okay, then what happened was 2 weeks went by for most people, and the first day of your second pay period, that is your date of entry into Acera. And this is the day that you become an Acera member and that you start earning that credit toward retirement. Now, for 2 of our employers, Livermore Area Recreation and Parks District and the Housing Authority, those 2 dates are the same date. There's no 2-week lag time. Your date of hire is your date of entry into Acera, but for everyone else, it's 2 weeks after your date of hire. Okay, so now you're earning credit toward retirement, and you're earning credit in 3 different categories, which I'll talk about in just a minute. You're earning credit toward retirement as an Acera member, and 5 years goes by. And once you have earned 5 years of service credit, so this is 5 full-time years or the equivalent of 5 full-time years, you're considered vested in the retirement system. And vesting kind of means guaranteed. It's kind of a loose term, but the vested benefits are the guaranteed benefits. So what happens at 5 years is that all of a sudden you become eligible for the guaranteed benefits. Okay. And then another indeterminate period of time passes and you achieve retirement eligibility. And it's indeterminate because it's going to be based on some combination of your years of service, so how long you've worked, and your age. And there's a few different combinations that get you to retirement eligibility. I will show those to you in the second half of the presentation. And this is the first day that you could actually retire if you wanted to. Many people do not retire on this day. Many people continue working after that, which is why I left some space after here, and earning more and more retirement. Because the longer you work, the more credit you earn toward retirement, the higher your retirement allowance is going to be. And that's why people continue to work, because the retirement allowance gets more and more and more. And I'll show you how that works in like 3 minutes. Next date on the pension milestone chart is your last day of work. This is sometimes called your termination date or your last day on payroll. This is your last day of work. This is when you stop earning credit toward retirement. And for many people who are planning on going straight into retirement from their active status with Acera, which means you're actively employed and you're actively working and earning more and more retirement, many people will go straight into retirement, which means these 2 days will be consecutive days. So the next day after your last day of work will be your first day of retirement. And then this is the day, your retirement date, that you start collecting that retirement that you have been earning throughout your entire career. Now, for a few of you, there will be a gap between these 2 days. You will stop working and you'll defer your retirement to a later date, and that's perfectly fine. People do that all the time. There's some definitely good reasons to do that. But many of you will go straight into retirement, and I'll kind of talk about, what happens, what the difference is between whether you go straight into retirement or not a little bit later. Okay, so you retire, and now you're collecting your retirement payment for the rest of your life until your death. That's when your retirement payments stop. When you retired, though, you had the opportunity by choosing among the 5 different retirement options. 4 of them will allow you to leave a continuing payment to a beneficiary. So they could get a monthly payment for the rest of their life. In most cases, it's for the rest of their life. And I'll talk about that later, what the various cases are. And that is when we have fully paid you out all of the benefits and your beneficiaries all the benefits that you've earned by participating in a SARA. Okay, at this point is when I will orient you to the worksheet, okay? So what you're going to do, and let me show this to you, is you're going to go to asera.org. You are going to, and really you can do it from any page. I just like to orient you from the home page. You go over to news and events, pull that menu down by hovering over it. You go down under retirement planning seminars. You're in a retirement planning seminar right now, in the pre-retirement seminar, and it's the webinar version of it. You're going to scroll down right under the first heading, webinar options, open up the accordion for pre-retirement webinar. Right there is a PDF link, retirement planning worksheet. So you pop that open, and this is a worksheet that you can fill out if you want to as we go along. What I've found is that in the past, when I didn't have the worksheet, it was a little hard for people to process all of the things that they were learning about their specific membership with Asera, because there's a lot of numbers that are particular to you, like your tier and the estimate of your retirement and your Asera entry date and all that. So these are all the things that you might want to keep track of once you learn them, and then you come back a little bit later and you're trying to remember what you learned, and you can just look at the retirement planning worksheet, okay, to get kind of a shortcut on that. So this is a PDF. It does have fillable fields. What you should do is go ahead and download it to your device and then fill out the fields, and that way you can save it and print it out. If you fill them out in your browser, you won't be able to save the numbers. Okay, so that's how that works. Okay, back to the slides. What you're seeing here. Oh, well, and also there's a shortcut to it, asera.org/worksheet, and it will take you right to the PDF. Okay, so this is just a piece of the worksheet, what you're seeing here. This is zoomed in on just a piece of the front page. This is the My Career Timeline section. This is where you can write down some numbers about some dates about your career timeline, okay? So your Asera entry date now, we know, is your first day of membership in Asera. Now, if you don't happen to know what that is, I would say the vast majority of people don't. The easiest way to go back and remember exactly what that date is to log into your account on our website. So if you go to asera.org and you press the login button, you log into your account, and you will find your Asera entry date in there and lots of other stuff that is useful. But you'll notice I've written approximate dates up here because you don't necessarily need to know what your Asera entry date is for any of this stuff. You just, like, once we get to the retirement eligibility, you just have to vaguely know, when you entered Asera. So you could put an approximate date in here. If you just like to know the month and the year, that's fine. Okay, so at this point, if you want to, you could write in a projected retirement date if you happen to have a date in mind. Now, you may want to pencil it in because you may learn something during the webinar that you may want to adjust your retirement date by a few days here or there, or a few weeks, okay? Now, Moving on to vesting, let me just say a couple more words about that. The vesting, like I said, comes with 5 years of service credit. That includes reciprocal service credit. And reciprocity is where you've linked various California retirement systems together to gain some synergy amongst them. And one of the synergistic effects is the 5 year, if you look at all the service credit total that you've earned across all of the systems that are linked together, you only need 5 years total among all of those to get over the vesting requirement and the retirement eligibility requirements. And the guarantee is by state law. So state law tells us how to govern a SARA, tells us how to do all of the things that we're doing, all the calculations, what all the rules are, and it ensures that we are there for you so that you have a guaranteed retirement for the rest of your life. The guaranteed benefits are that retirement allowance, and notice it says retirement benefit. That, again, that's just a synonym. That monthly retirement allowance for the rest of your life. Annual cost of living adjustment, which is an annual increase to that retirement allowance. I'll talk about that later in detail. And a $1,000 lump sum death benefit, which is considered vested. There are other death benefits, depending on which one of the 5 retirement allowance options you select. And I'll talk about all that pretty soon. Okay, now that you know your vested date, you just basically take your SARA entry date and add 5 years. You could, pencil that in here approximately. The vesting date isn't super important. If you already know you're way past 5 years of service credit, I wouldn't even sweat it. Okay, let me tell you about your tier. This is very important to know which tier you're in. So first off, you need to find out which one of these timelines to look at. If you're a safety member, which means that you are either a sheriff's deputy or a probation officer, and there may be some other sworn officers in there, you are looking at the bottom timeline. Everyone who's not a safety member is a general member. Okay, so the vast majority of people are general members. And then you're looking at the top timeline, unless you're a general member who works for the Housing Authority or a general member who works for Livermore Area Recreation and Parks District. And then you're going to look at the timeline for your employer. The way this works is you are put into a tier in a SARA based on your date of entry into a SARA. So your date of entry determines your tier. If you entered a SARA before the cutoff date for each tier, you go into the earlier tier. So for example, if you entered a SARA before July 1st, 1983, then that would put you in tier 1. And I see a question, what is the vested year for court employees? That's still going to be 5 years. Vesting is 5 years for everyone. And for court employees, you're going to be looking at the top timeline. Okay. Now, if you entered a SARA July 1st, 1983, all the way up to December 31st, 2012, that would put you in tier 2. If you entered a SARA January 1st, 2013 and beyond, that would put you in tier 4. And that is the case you can see all of the timelines. Okay, so that's how the cutoff dates work. And that's how you end up in a particular tier based on your date of entry. Now you'll notice safety members have a few more iterations of tier 2. If you're either in tier 2C or tier 2D, that is a selection that you made once you became a safety member. If you don't remember what it is, you can log into your account on our website and it will say exactly which tier you're in. And that is actually the case for everyone. You log into our website and you will see your tier in there. So if you don't know your entry date, you don't quite know what tier you're in, you want to know, you want it to be defined for you definitively, that is in your SARA account. If you go to asara.org, click the login button and log in there. Okay, so that is how the tiers work. Now, if you want to, here's another piece of your worksheet where you can put an X on your tier if you so choose. Okay, next topic, estimating your retirement benefit. Okay, now that we kind of have a base understanding of your SARA membership, let's talk about how to get an estimate of your future retirement benefit. And one of the best ways for me to explain how to get an estimate of your retirement benefit and for you to understand it is if I show you the pension formula and explain to you in a little detail the 3 factors that go into the formula. That will help you understand how to maximize your pension benefit. And It will understand when you see what the retirement allowance number is from the benefit estimator, how we are determining that. Okay. So let me help you understand this. This is actually, I mean, you're seeing math here, but it's actually not that complicated. Okay. And when I said earlier that you're earning credit toward retirement in 3 categories, these are the 3 categories. The age factor percentage category, years of service credit, and highest average monthly salary. Okay, here's how this works. You are currently working or you're deferred, and you are going to retire. You're planning on retiring, which is why you're watching this. When you go to retire, what you are going to get as your monthly retirement allowance, the calculation that we're going to do for you is that you will get a percentage of your highest salary that you've earned from any time in your career. You're going to get a percentage of that highest salary for each individual year of service that you worked. Now, let me help you wrap your head around that idea by putting some numbers in this equation, because this multiplication that you're seeing here is the math version of what this English sentence is telling you. Okay. So let's say, for example, let me put some numbers in here. Let's say that the percentage of your highest salary that you are going to get for each year of service is 2%. So that means that you are going to get 2% of your highest salary for each, in this example, 20 years of service. So let's say that you worked for 20 years. You're going to get 2% of your highest salary for each individual one of those 20 years. So if you take 2% of your salary and put 20 of them next to each other and add it all up, that gives you the percentage of your highest salary that you're going to get. But instead of doing addition, we'll do multiplication. 2% times 20 years, so 2% for each one of those 20 years, is going to be 40% of your salary. This is going to be your retirement allowance, 40% of your working salary. Now let's keep putting some more numbers in here to finish out the example. Let's say your highest average monthly salary is $5,000 per month. 40% of $5,000 is $2,000. We just multiply them together, and that determines your retirement allowance that you're going to get every month for the rest of your life, because $2,000 is 40% of $5,000. You know, so it's actually pretty easy once you put some numbers in here. Now the bottom line here is that in order to maximize your retirement allowance, since this is a multiplication, you need to maximize, if you want to try to maximize this, you maximize each one of these 3 numbers. You maximize the age factor percentage, you maximize the years of service credit, you maximize the salary, and the higher any of these 3 numbers are, when we multiply it out, the higher your retirement allowance is going to be. So let me dive into a little more detail about how to maximize each one of these 3 numbers, okay? I'll tell you how each one of them work, how we calculate them, and that will give you an understanding of how to do this. I'll talk about the age factor percentage first. Let me look at this question real fast. Okay, the question is, you have reciprocity with another agency, so you have done some service for another agency that you have linked with a SARA. And the question is, are your years of service credit based on just your years with Alameda County, or is it combined with the other agency when we do the calculation? The answer is that it is not combined. Each individual agency, each individual pension system that you have linked together, they will each do a formula for you that will multiply out your numbers from each agency and give you a dollar amount from each agency, and we each individually send you a check. So if you had 10 years over at Contra Costa County, their equation would have 10 years here. And if you came over here and worked here for 5 years, our equation would have 5 years. Now, both equations are going to have the highest salary you earned under any system. And that is the synergy you get with reciprocity, where all of the systems use the highest salary from anywhere that you worked that you have linked together. Okay, so let me tell you about the age factor percentage. How do we determine your age factor percentage? Which one of these percentages are you going to get of your highest salary for each year of service, because it's not necessarily going to be 2%. The way we determine it is we use this age factor percentage chart. This is an example of some of the age factor percentages. And the way that you navigate this is you just find your tier and you look at that one column. Okay, so if you're a general tier 2 member, you just look at general tier 2. You forget about all the other columns because they don't apply to you. So what happens is when you go to retire, let's say that you're going to retire at age 60 as a general tier 2 member. Well, we get out our chart. I mean, really, our software does all this, but we get out our chart. We go down to age 60. We go over to tier 2 general. We see it's 1.92%. That is the percentage of your highest salary that you're going to get for each year of service because it's based on your age at retirement. And you'll notice the percentages get higher the older you are when you retire. So when I said how to maximize your retirement in this category, it's simply by retiring at an older age. And you'll also notice that there's a maximum age factor percentage that you can get for each one of the tiers. So if you retired at age 65 under general tier 2, that would be the maximum, 2.43%. The maximum percentage we can put in the formula for you. If you retired at 66 or 67 or 77, it would still be 2.43%. So the numbers stop increasing once you reach the maximum for your tier. And you may also notice that I skipped a bunch of the ages here. There's big gaps here, and that's because there's actually so many incremental increases that they don't all fit on the slide because they increase with every 3 months, every quarter year that passes that you get older and don't retire yet, you go up one notch in this age factor percentage chart. So the quarter year is based on your birthday. So for example, if your birthday is January 15th, one quarter after your birthday is April 15th. You pass that date, don't retire yet. You go up another notch in the age factor percentage chart. You get a slightly higher age factor percentage in the formula for you. July 15th passes, you go up another notch in the chart. October 15th passes, another notch. Back to January 15th, your birthday again. Happy birthday. You don't retire yet, you go up another notch. And so that's how that works. So I'm going to show you later about how to be cognizant of those 4 dates so that you maximize the age factor percentage in the formula for you. Let me see. Do I need to tell you anything else about this part of the formula? Last thing is if you do want to see what all the incremental increases are because you happen to enjoy math and percentages, we do have all those posted out on our website at acera.org/age. Okay. So moving on. I told you about the age factor percentage. Let me tell you about the second part of the formula, which is the years of service credit. And let me turn off my ceiling fan real fast. Okay. So here is the pension milestone chart one more time. I told you earlier that you start earning service credit when you enter Acera. You're going to continue earning service credit all the way up until you stop working, your termination date. And you earn service credit while you work during your regular work hours. And you also earn service credit during your earned leave time. Vacation leave, sick leave, management leave, compensatory time, holidays, floating holidays, none of those count against you for the purposes of earning service credit. You already earned service credit during those times when you mark those on your timesheet. Okay, now that's the list of times when you do earn service credit. Here is the list of times when you do not earn service credit. If you ever go out on leave without pay, you don't earn service credit while you're on leave without pay. Second is that if you purchase extra vacation, some of our employers will allow that, which is that you want a little bit more vacation on more than what you earn. You can purchase extra, but when you take that extra vacation and mark that on your timesheet, you don't earn service credit for that time. Now, some people feel a little anxiety about that. Whenever I sit down and do the math on this, and I math it out, and I see that if you have taken a purchased vacation week here or there, whenever I've done the math on that, it doesn't affect your retirement allowance much. It's maybe like a few dollars. So if you've taken a purchase vacation here or there, I wouldn't sweat it. I don't think that's something to get stressed out about. Okay, next. So if you sell vacation back to your employer, totally different concept, which is you take your earned vacation and you sell it back to your employer because you are not going to take the vacation, you just want the cash. You don't earn service credit during for selling that vacation. Now, you do earn service credit because you would have gone on a week of vacation, but instead you're working. So it's not like it counts against you for earning service credit. And in the service credit column, you don't earn service credit, but in the salary column of the formula, the salary part of the formula, you could get salary credit for it, which I will talk at length on when I talk about the salary part of the formula. So hold on to your questions about that. You also do not earn service credit during overtime, on-call time, or standby time. Okay, there's a couple of questions. Let's see here. Okay. So the first question is temporary disability considered leave without pay if the state is paying your salary? So if the state is paying your salary and you're out on leave and you're not getting salary from your employer, that is considered leave without pay. And so you're not earning service credit during that time. But if it's a medical leave, unpaid medical leave, that is one of the categories that is purchasable, which leads into our next topic, the next question that was on there. Can we buy service time? And the answer is yes. There are some types of time that are eligible for you to purchase as service credit, and that would increase your amount of service credit in the formula for you. So the way that you maximize the service credit part of the formula is in two ways, either by working longer and earning more and more service credit, or by purchasing one of these types of eligible time. And here are a few examples. Any part-time work that you did before you achieved your full-time retirement eligible position. I'm just talking about plain old part-time work, not working for a temporary agency or an employment agency or working under contract. This is just plain old part-time. Once you become an Acera member, you can go back and buy that part-time work. You can also buy all of the county's temporary assignment pool work, which is what TAP stands for, any work you did in TAP. Project work before your full-time or seasonal, intermittent work. There's different labels for that type of work. That's purchasable. The 2 weeks between your date of between your date of hire and your date of entry is purchasable. Unpaid medical leave, disability leave, or military leave. The military leave is where you go out you're actively working, you go out on military leave during your active employment, and then you come back from the military leave, or you come back from the disability leave or the unpaid medical leave. Then that becomes purchasable when you return. And so to answer your question about the state disability insurance leave, that would become purchasable time. Now, the next category is a redeposit of prior memberships. This is where you used to be an Acera member in the past, and when you stopped working here for your employer, you took a refund of your contribution account because you needed the cash. And then you come back to work here and you want to get the service credit back that you lost because when you took the redeposit, that basically canceled your membership and you lost all your service credit. So now that you're back, you can put the money back to get your service credit back from the original membership, and that's a redeposit. And then if you used to work for another California public agency, you can buy that time. If you are not eligible for their pension, or usually it's because you're not eligible for their pension because you didn't work there for long enough, or you've taken a refund from their pension system, then you can buy that time. So for example, like a year working at East Bay Mud, you could buy that as a Acera service credit. I don't take a deep dive into the service credit purchase topic in this presentation. I do that in the new employee / mid-career webinar. And we do have a video of that out on our website at acera.org/seminars. And there is a full article at acera.org/purchase. But if you did want to go look at that part of the new employee / mid-career webinar where we talk about service credit purchases. What I recommend doing is you click on the YouTube video and you fast forward to this slide right here, where we start talking about earning service credit, and then we take a deep dive into it on that one. Let me see if there's any questions here. Do you need to provide records of medical disability leave that you took? You may need to if you're making an unpaid medical leave purchase, because the unpaid medical leave is for your medical conditions only. That would be a question for my colleagues, and you can contact us if you go to acera.org/contact. There's an email form you can fill out, and there's our phone number there, and I can give it to you right now. Our phone number is 510-628-3000. So again, that's 510-628-3000. And we have a dedicated call center there where there's people in there that their only job is to answer your questions and counsel you. So I would definitely ask them if that's part of the process of making the service credit purchase. Okay, there's a question about timing for choosing your retirement date with the COLA. We'll definitely talk about that later, so I'll save that question. And then there's a question about bumping your salary from vacation. We'll definitely dive headlong into that topic in just a few minutes. Let me finish out the service credit topic. The last thing I want to say about service credit is about what happens to your unused sick leave. So what happens to it is, if you go straight into retirement from active work, which means that in this illustration you're seeing in the blue, you're on active pay status. You actively have a job with one of our 6 employers. And you go straight from active work into retirement, which means that your last day on payroll is the day before your retirement date. Or another way to say it is your retirement date is the next day after your last day on payroll. And there's no gap here. That means you're going straight from active work into retirement, and we will convert your sick leave to service credit on a 2-to-1 basis. So you'll basically get half of your unused sick leave as additional service credit, up to a cap. And the cap is a little bit different for the different bargaining groups. So you are going to find the cap in your memorandum of understanding, which is also known as your MOU. Many of the caps for many of the MOUs limit this conversion to 125 days of sick leave. Okay, so the way this would work is that, let's say that you're in one of those bargaining groups that has the cap 125 days of sick leave, and you have 130 days of sick leave on the books when you stop working and retire. So what we do is we can only convert up to the cap. So the 5 days over the cap you lose, and then we take the 125 days left over, we divide it by 2, and that tells us that we are going to add an additional 62.5 days of service credit to your service credit number in the formula for you. Now, this is business days. This is not calendar days. So 62.5 days, if you work 5 days a week, is a little over 12 work weeks, which is about a quarter year. So you would get another 0.25 years of service credit added to your service credit number in the formula for you. Now, this does not change your retirement date. This doesn't push your retirement date out at all. Your retirement date is your retirement date. The only thing that this conversion does is it increases the number we put in the formula for you in the service credit section, okay, of the 3 different retirement formula factors. And the other thing I want to mention is, I just mentioned some decimal places. That means that it also means that for everyone, because we are measuring your service credit down to actually the fraction of a day, every 15 minutes you work, you earn 15 additional minutes of service credit. Your service credit number, when you log into your account, will have a bunch of decimal places after it. You'll see it'll be like, 16.75262 years. And that's us measuring the service credit down to the fraction of a week. And we put all those decimal places into the formula. So you get all the credit for every minute that you work. And that's why I emphasize that you're getting credit from the minute that you become an Semianr member all the way up to the end of the day on your termination date. Okay, so that's service credit. We talked about how to maximize the age factor percentage by just by getting older. Basically, that one's pretty easy. You don't really have a ton of control over that. But the older you are, the higher the age factor percentage. We talked about maximizing it by having more service credit, more and more service credit. Now, let me tell you about the highest average monthly salary component of the formula, how we calculate it, and how you can maximize that one. Okay, first off, let me tell you how we determine what your highest average monthly salary is going to be. Okay, what the law tells us to do, how to calculate this, is that we need to find throughout your entire career what we call your final compensation period is, which is your period of highest pay from anywhere in your career. It's your period of highest consecutive pay. And the pension lingo calls it final compensation period. Now, if you're in tier 1 or tier 3, your final compensation period is your highest consecutive 26 biweekly or 12 monthly pay periods. If you're in tiers 2 and 4, it's your highest consecutive 78 biweekly or 36 monthly pay periods, depending on whether you're paid biweekly or monthly. So essentially, for tiers 1 and 3, we're looking at your highest year of pay, approximately. For tiers 2 and 4, we're looking at your highest 3 years of pay, approximately. And what we do to do this calculation, our goal for the formula, what we need to plug in is an average of your highest average monthly salary, what you were getting paid on average per month during this final compensation period. So it's actually a very easy calculation to take an average. We just take your total pay over the 3 years or the 1 year. We divide it by the number of months in that period, and that gives us your highest average monthly salary. That's the salary that we plug into the formula for you. For the vast majority of people, this is going to be the period at the end of your career because you're making your highest rate of pay at the end of your career, but not for everyone. There are some people that will take a different position at the end of their career just to kind of de-stress a little bit and kind of ease out, and that's totally fine. Your final compensation period will be sometime earlier in your career. Okay, so what kinds of pay are included in this calculation? What are we looking at when our software does this calculation? First of all, I'm going to show you 4 types of pay that are going to go into this. And for all of them, we're talking about gross pay before any deductions are taken out. The first type of pay that goes into the salary calculation is your base pay. Of course, that makes sense. The second type of pay that could go into the salary calculation are some other pay codes you may have, sometimes known as footnotes. Now, there's like 1,000 different pay codes. I can't tell you off the top of my head whether your pay code is in or out of this equation, but you can find out for yourself by visiting acera.org/paycodes. You click on the link for your employer, a PDF opens, and it has a list of all the pay codes. You find your pay code, and it'll say yes or no, whether your pay code is in or out of this equation, whether it counts toward your salary calculation or not. The one pay code I do know that never counts is overtime. Overtime never counts. Okay, now there's 2 more bullet points here, 2 more types of pay that could be included in your highest average salary calculation. Okay. The first is vacation sales. So this is where you sell vacation, your earned vacation, back to your employer for cash while you're still working. The second is vacation cash out. This is where you have vacation left over on the books when you stop working, and they will cash you out for the balance of the vacation that you have on the books. In both cases, you are receiving pay for that, and that could be counted toward your highest average salary if you're in tiers 1 and 2. It's not for tier 4, so the law that created tier 4 disallows this. So sorry about that if you're in tier 4. And for tier 3, LARPD doesn't let you sell vacation, and you have to be able to sell vacation You don't have to physically sell vacation, but you have to, be able to have any of this included. And it's a weird, convoluted part of the law, but that just disallows tier 3 people from being able to do this. So we're just talking about tier 1 and tier 2 people can have some of this vacation sales and vacation cash out included. And I keep using the word some. Tier 3 and tier 4 members, you can take a little snooze for about 15 minutes if you want to, or you can, if you're curious, you could just hang out. I say some because there's going to be a limit on this. There's going to be a limit on how much we can put in, and I'm going to talk about that in just a minute. Okay. So let me just kind of help illustrate this entire concept for you, because it can be a little confusing. So I just want to lay it all out step by step for you. First off, if we're thinking about you getting paid, getting compensated for your vacation, we're looking at the vacation that you are compensated for. This is your earned vacation that you're not going to take. You're not going to go out on the vacation. You're basically going to get cashed out for it, or you're going to sell it for cash to your employer. Okay. We're talking about only the vacation that you sell during your final compensation period, whatever that is determined to be, and the vacation that you cash out during, right at the end of your final compensation period. Now, for those of you whose highest period of pay was earlier in your career, the vacation cash out isn't probably going to work for you, because you were making more money earlier. And so if you sold vacation back during that earlier period, that would boost your pay. So mostly who we're talking to are the people who are making your highest rate of pay at the end of your career. And that is how you can think about getting a little boost based on this compensation. Okay, so vacation sale, like I said, is where you sell vacation back to your employer while you're still employed. Vacation cash out is you simply have vacation left over on the books when you stop working that you haven't taken. And at that point, your employer will see that you have vacation left over and they'll cash you out for it. So you'll get more money in your last check, or maybe there's a separate check that comes. Either way, when we go to calculate your retirement, we see that you were paid for in your payroll records in our database from your from selling vacation or for cashing it out, because all of your payroll records come into our database from your employer, so we can do these calculations. So what we're talking about is the combination, the total, the sum. That's why I'm adding it together here in this graphic. The sum of vacation cash out plus vacation sales equals your total vacation compensation from both of these categories of getting compensated for your vacation. And this is total vacation compensation during this final compensation period. This highest year of pay in tier 1 and tier 3, or highest 3 years of pay in tiers 2 and 4. Okay, so now we've kind of defined that. The theme here, kind of the overarching idea, the concept is that if you are compensated for your earned vacation during that final compensation period that we're using to calculate your salary for calculating your retirement, that means that your total salary during the final compensation period was a little bit higher, a little bit bigger, your total salary during that period. Now, because your total salary is a little bit bigger, your average salary is a little bit bigger. Because your average salary, remember, is one of the 3 multipliers in the retirement formula. That means when we do the multiplication, your retirement allowance gets a little bit bigger. So the bottom line there is that getting compensated for your earned vacation boosts your retirement allowance a little bit. Now, when I say a little bit, how much do I mean? These are approximate percentages that being compensated for your vacation will increase your retirement allowance. What you're seeing here is the number. This is listed in weeks of vacation that you're compensated for during your final compensation period. So let's say you sold 3 weeks and you cashed out 3 weeks for a total of 6 weeks of vacation compensation during your final compensation period. If you're in tier 2, that would boost your retirement allowance by 3.8% approximately at the time of retirement and for the rest of your life. You would start out with a 3.8% higher retirement allowance from being compensated for those 6 weeks of vacation. So that's how the chart works. You can see that it could go all the way up. These days, because of a reinterpretation of the law that tells us how to calculate this, it's not a lot of people can get up to 12 weeks. But if you were compensated for 12 weeks of vacation, you could get a 7.7% boost. And you can see the tier 1, the boost is accelerated because of the shorter final compensation period of 1 year. Okay, so this is approximate. And the reason I like to show you this chart is, people are questioning, is this worth it to understand? Is this worth it to, perhaps think about targeting if you were going to do it? So it could be if you get a, almost 4% boost to your retirement allowance immediately upon retirement and for the rest of your life. So you can determine that for yourself based on that chart and whether it's worth it for you. Now, there is a cap on how much of vacation compensation a SARA can include as salary for the purposes of calculating your retirement. You'll notice that the slide says must include. We have to include it. The law tells us how to calculate this. If you are compensated for your vacation during this final compensation period, we have to consider it salary for the purposes of calculating your retirement allowance. That's defined by state law, so we have to do it. And so what I like to do is show you a bunch of slides and tell you exactly how we do it, because if we have to do it, then I might as well show you how it works. Now, there's some people who work maybe in the private sector who don't have pensions, who read some, kind of inflammatory newspaper articles, who might get a little bent out of shape about this concept, but this is the law. This is how it has to happen, and it's the law because at some point in the past, there was a group of employees in Ventura County that thought this little bit of vacation compensation is salary. It's something that they earn and it should be included. And then through a entire history of, different court cases, the way that we do this has become established. And so this is my little justification for explaining to you how to, do this little boost to your retirement allowance. Okay, because we have to do it. So I might as well tell you how it works. Okay, so, and when I say we have to do it, I mean if you're compensated for vacation during that final compensation period, we have to include up to your cap, what we can include. Okay, so let me help you find your cap, because you all have a limit on how much vacation compensation we can include. So first, I'm going to talk to the Alameda Health System employees because your calculation is a little bit different, and then I'll talk to everyone else. Okay. What you're seeing here is a piece of that worksheet, that retirement planning worksheet. And this is on the second page. So you look under the Alameda Health System section, and then you can fill out your numbers as we go along here. Okay, so what you're going to do if you work for Alameda Health System is you need to know one number. You need to know how many hours of paid time off, also known as PTO, that you earn per pay period. And I believe it tells you this on your pay stub. So you just go to your pay stub, you see what the number is. In this example, this person, their number was 6.7692 hours of PTO that they earn each and every pay period. And then you get out your calculator, do a little bit of math. If you're in tier 1, you multiply it by 13. If you're in tier 2, you multiply it by 39. So in this example, 6.7692 times 13 is 88 hours of vacation worth of 88 hours worth of vacation compensation. For tier 2, in this example, it's 264 hours worth of vacation compensation. Okay. So this is the maximum amount of hours worth of vacation compensation. So worth of the cash that you would get for cashing in, for example, 264 hours, that we are allowed to include for you as salary for the purposes of calculating your retirement if you're in Alameda Health System. One more group that I want to mention is that if you're in the UAPD union, you all have the same cap. So you don't have to do any math. You just got to look at this note right here. If you're in tier 1, the cap is 120 hours. If you're in tier 2, the cap is 360 hours of PTO. Okay, so that's Alameda Health System employees. That's your cap in hours. Okay, now I'm going to talk to the county employees and the other employees. I think there's 2 other. Let me just remind myself which 2 other groups this counts for. Okay, it's Alameda County, the courts, and the housing authority. You all are able to do this. Okay, so, and again, we're talking to tier 1 and tier 2. So what you're going to do is look at this section of the worksheet. So this is slightly below the other section. Again, this is on page 2. To determine your personal cap on how much vacation compensation we are allowed to include as salary for the purposes of calculating your retirement, you are going to need 2 numbers. You're going to have to know how much vacation you earn per year. So it's in weeks. It's either 2 weeks, 3 weeks, 4 weeks, 5 weeks, 6 weeks. It's one of those numbers. How much vacation you earn per year, and you put it into this field. The second number that you're going to need to know is how much vacation you are allowed to sell per year. Somewhere in your employer's rule book, it could be in their policies, it could be in your handbook. Maybe it's just something that your payroll clerk happens to know and they know what the limit is. And if you don't know what it is, you can ask your payroll clerk. You need to know how much vacation you're allowed to sell per year. It's probably 2 weeks. It could be 1 week. It could be 3 weeks. I don't know if there's any people that can sell 4 weeks per year anymore. But you need to know that number. You don't actually have to sell. You just need to know that you can do it. It's in the rules, and you need to know how many you can based on your position and bargaining unit. Okay, so you come out and you put those 2 numbers in the worksheet. Now, if you're in tier 1, you only need to fill out the first column. If you're in tier 2, you need to fill out all 3 columns here, okay? And that means that you need to think about what your final compensation period is going to be. And you can get a loose idea of this, especially if your period of pay is the highest at the end of your career. You just take what your retirement date is going to be, and you subtract 3 years, and that is your final compensation period. A more precise way to do it is to use our online calculator. You log into your account, you estimate a benefit, and in your plausible retirement scenario that you're likely going to do, it will give you, it will show you what pay periods your final compensation period is going to be. Okay. And basically what you need to know is you need to say how many weeks of vacation you are earning at the end of each individual 1 year of that 3-year final compensation period. So you might transition from earning 4 to 5 at some point during that 1-year period. If that's the case, you put in 5 for that period. Okay, then you got to put in how much is payable to you, how much you're allowed to sell. In most cases, the payable number is going to be smaller than the earned number. Okay, now you need to take an extra step here. You need to get a limit. You need to take all these numbers, go out to the calculator on our website, and figure out what the limit is for you. The calculator will tell you. And I'll actually show you how to add it up for yourself. It's actually pretty easy. But let me go out to the calculator, and I'll just show this to you. You're going to want to go to acera.org/vacation. And it says that on the worksheet, acera.org/vacation. And that is a shortcut. Once you let it fully load, that's a shortcut to the spot on the page titled Understanding How Unused Vacation Leave Affects Your Retirement Allowance. Tier 1 and Tier 2 only. You open this first accordion, and you will find the calculator sitting in here. If you're in Tier 1, you leave it at Tier 1. If you're in Tier 2, you select Tier 2, and then you would put in how many weeks of vacation that you earned, delete all of the zeros. From the drop down here, you select how many weeks of vacation you are allowed to sell. If you're in Tier 2, it will expand and let you do 3 years worth. So in that example, it was the same for all 3 one-year periods of the 3-year final compensation period for tier 2. So I'll just put everyone in. And you can see it's giving me a running total as I put numbers in. Now, really what it's doing is it's taking the lesser of these 2 numbers for each of the year periods and it's adding them up. So the lesser of 5 and 2 in all 3 cases is 2. So it's adding 2 plus 2 plus 2. So it's not a very complicated calculator. And if you know that, you don't actually have to use the calculator. So you can see here, all I need to do is see which number is less and add them together. 2 plus 2 plus 2 is 6. So the limit from the calculator is 6 for this in this particular example. And then there's a question, when we get to the calculator on the worksheet, please tell us what button will calculate the result. There is no button that is calculated. As soon as you put numbers into it, it gives you a running total. And if it's not doing that, let me know. But again, you can just kind of calculate it yourself. You just take the lesser of each of these 2 numbers and add the lesser number up. Okay, so it's, pretty easy. Okay, so now that we know your limit of how much vacation compensation we can include for you as salary for the purposes of calculating your retirement, then let's talk about if you want to get compensated for your vacation up to your limit, what would you need to do? Or it doesn't have to be up to your limit, but somewhere under your limit. What are we looking at? What would you need to do? Okay, so one example would be that in this scenario, you would just need to have 6 weeks of vacation left over on the books when you stop working. And you don't actually need to sell any, okay? So you just don't worry about selling any. The fact that you are allowed to sell lets you do this, but you don't actually have to sell any. You could sell 0. You just have 6 weeks on the books. 0 plus 6 is 6. And you got up to the limit of cash vacation compensation for vacation. And we will put 6 extra weeks of your salary into the salary calculation for you, which gives you the retirement allowance boost. Now, let me give you a slightly different scenario that some of you will be in this situation, okay? Some of you will be in the situation where you don't need to sell anything and you just cash it all out and it's fine. Some of you will be in the scenario where you may need to sell if you want to maximize this. And so here's an example of that scenario. This person earns 4 weeks. They're in tier 2 because you can see that they're filling out all 6 of the boxes. For tier 1, it's super simple. There's no scenario where you need to sell vacation. You can always get up to your limit by cashing out. Okay. For tier 2, in some scenarios you can't. And so, for example, this person earns 4 weeks of vacation per year, and they did that all 3 years of their final compensation period. And during that entire time, their employer allowed them to sell 3 weeks of their earned vacation if they wanted to. Okay, now you already know how the calculator works. We take the lesser of each of the 3 numbers, add them together. 3 plus 3 plus 3 is 9. So that's what the calculator is going to tell you if you go punch it in there. So their limit of vacation that vacation compensation we could include as salary for calculating their retirement as 9. Now, your employer has this extra rule that you need to know about. Their extra rule, just to make it more complicated, I don't know why they do this, but maybe it's just to make it more complex. I have no idea. Their rule is that they will not cash you out for more than 2 times your accrual rate. In this case, this person's accrual rate per year is 4 weeks. Every year they work, they earn 4 weeks of vacation. 4 times 2 is 8. This person can have no more than 8 weeks of vacation on the books and get cashed out for it. If they had 9 weeks of vacation on the books because they were trying to get up to their limit, how much we can include in their calculation, they would actually lose that extra week of vacation. So if they didn't do anything with that extra week of vacation before they stopped working, that extra week would just go poof. It would disappear. They wouldn't get paid for it. They wouldn't get any sort of credit for it. It would just vanish. and they would get cashed out for just the 8 weeks because that's the maximum that your employer will do. Okay, so what do? You can probably already see where this is going. What do? Well, you cash out the maximum, the 8 weeks, and then while you're still working, because you're watching this pre-retirement webinar in advance, you haven't retired yet, you still have time. You could sell that additional week of vacation in anticipation of trying to get up to the 9, and then simply have 8 weeks on the books. And 1 plus 8 is a total of 9. And that would mean that we are going to include 9 weeks worth of vacation compensation as salary for the purposes of calculating your retirement. Now, one more thing I want to point out: you actually have to, get paid for the vacation, get compensated for the unused vacation. Like if these were both 0, like your limit is 9, but you didn't sell any, you didn't cash out any. Well, there's no salary numbers that are going to go to boost your retirement. You actually have to sell it or cash it out. Okay, just wanted to point that out. Okay, now some of you may ask, well, what if I already sold a bunch of vacation? Like this person only needs to sell 1. Well, what if they sold 5? They already sold a bunch of vacation, or they're in the scenario where they don't need to sell any. Because if you go back and you see the previous example, 2 times their accrual rate is 10, 5 times 2 is 10. And so they can get up to their limit of 6 easily by simply having 6 weeks of vacation on the books, and they don't have to sell any, and they're not in danger of losing any vacation. So if that's your scenario, you don't even have to sweat it. Okay. But what happens if you sold a bunch of vacation already? Well, that it's totally fine. So don't stress out about it. It's totally fine if you've already sold vacation. You have 2 options. Option number 1 is that you can cash out the difference. So you calculate your limit, you look at how much you've already sold, and you simply subtract that from your limit, and that gives you how much more you would need to cash out to get up to your limit. 5 plus 4 is 9. Okay. So that's one option. Option number 2 is that you could even cash out more, and that's totally okay. So don't sweat that either. If your retirement is coming up, you're going to stop working, you have a bunch of vacation on the books, you've already sold a bunch, like you've already sold 5, you have 8 on the books, you're going to cash out 8, your limit is 9, that total, that's 13 weeks. It's totally fine. Don't sweat that. Okay, what we're going to do is when we look at your records, we're going to go, okay, your limit is 9. We see that you were compensated for 13 weeks worth of your vacation, and that's totally fine. We're just going to take 9 weeks worth of that 13 weeks, and we're going to use those dollars, those dollars in terms of math, in terms of numbers, and we're going to consider that salary for 9 weeks worth of the 13. We're going to consider that salary for calculating your retirement. Now, let me be clear here. You're not buying an extra boost to your retirement. No, in fact, you're getting paid. When you sold this vacation, that went into your bank account. That's your money. When you get cashed out for this vacation, that goes into your bank account. That's your money. Okay. It's the fact that you're getting paid the money that we see the numbers come through in your payroll records. And in this scenario, you would be maxing out the amount of the dollars that we are allowed to include as salary for the purposes of calculating your retirement. Okay. So let's see what questions I have on this topic. Okay, so the one question that was up on the board, yeah, I think I answered both of those questions already. So let me know if you have any follow-ups to that. I'm going to save the COLA question for later. Okay, the question is, what if you're currently working for another public agency? How can a SARA find out the last 3 years of the salary if you don't work for a SARA? Because it sounds like you have reciprocity, okay? Because you're inquiring about, the salary between agencies. What's going to happen is that you are currently a deferred member of a SARA, so you're still in a SARA member. You have just stopped working here and you're working for another agency and earning a pension under their system. So you've stopped working here. And when we go and look at your record in our database, it's going to say that you're a deferred member. You're still a Semianr member. Your just account is just kind of on hold, and you have reciprocity. So you've linked the systems together. Now, when you submit a retirement application, we're going to look at your account. We're going to see, oh, you have reciprocity. We're going to call up your other agency, and we're going to find out what the salary is that they calculate it to be. And so they're going to do their own calculation. It's likely, since you're working there after you're a SARA membership, that you're probably making more money over there. So we would use their salary when we do our calculation. If that's not the case, if you made more money here, then they would use our salary. So in either case, we use the highest salary that you earn under any of the linked systems. Okay, so you're saying estimate my retirement is not calculating. So if you're talking about the estimate a benefit, I'm not sure why that would be the case. So that would be, it sounds like you're logged into our website, into your account on our website. You're trying to use our benefit estimator. You're plugging all your numbers in and you're hitting estimate a benefit and nothing's happening. What should be happening is a PDF is popping up. So you may look to see if you have a pop-up blocker turned on, but a PDF should pop open in a new tab, or it should pop up for you to download. That is what should be happening. If not, I can't really do technical assistance with you during the webinar, but what I recommend is calling the experts. You can contact them by email at asera.org/contact, or you can call them at 510-628-3000, and they can walk you through that, and they can do some troubleshooting with you. Sorry that's happening if that's what is going on. Okay, so next question is this for the fiscal year or for the calendar year? It is. Okay, so the weeks of vacation that you earn is something that you earn per fiscal year. The weeks you're allowed to sell is per fiscal year. Okay. So you are allowed to sell, in this case, 3 weeks in June, and then you could sell 3 weeks in July once the new fiscal year starts, if that's something that you wanted to do. So these are both for fiscal year. Now, your final compensation period is neither per fiscal year or per calendar year. It is based on your highest pay periods. And in almost every case, your highest pay periods are not going to line up exactly with the fiscal year or calendar year. If you're making your highest rate of pay at the end of your career, for tier 2 and 4, you just take your retirement date, you subtract 3 years, and that becomes your final compensation period. If you're in tier 1 or 3, you take your retirement date, subtract 1 year, and that's your final compensation period. If you are making a higher rate of pay earlier in your career, log into your account on our website, and I'm going to show you some screenshots of this pretty soon, but you log into your account, use the benefit estimator, and it will tell you what your final compensation period is. Okay, next question. If you sell 2 weeks of vacation as tier 2, you're in tier 2, you sell 2 weeks of vacation. For the last 3 years of employment, does it bump your salary so you get more when you retire? Well, in that case, you would be selling basically 2, 2, and 2. So this number would be 6 for you, what you actually sold. Okay. Now it all depends. As long as you are working for the county, the courts, housing authority, or Alameda Health System, and you sell vacation, it's going to boost your retirement allowance. Okay, and it sounds like you're in tier 2, so yeah, it will. But it's going to be a combination of the vacation sell and vacation cash out. So maybe what you're asking is, can you, if you sell more vacation, can you have more weeks of vacation pay included than this limit? No, this is a hard limit. This is what the law tells us to limit it at. And there's no way you can ever go above this limit of vacation compensation included as salary for calculating your retirement. So it's going to be the vacation cell amount plus the vacation cash out. Next question, how do you find out your allowable vacation cell if you're exempt and are under no MOU? You would need to ask your payroll clerk because usually they're the ones that will handle the vacation cell. And so they'll know what the limit is for you. And if not, you would ask your HR representative, human resources. Okay, next question. I sold 6 weeks over the last 3 years. So how does that work? Yeah, so you sold 6 weeks. So you have the vacation, you go out and do this calculation, you find out your limit, you plug in 6 weeks here, and then you would just, like I was saying earlier, you have two options, which is you cash out the difference. So this would be 6. If your limit was 9, you would cash out 3, get up to the 9. But you need to know what your limit is. You need to use this. Oh, and it says you have none. You have no vacation left. Well, it sounds like you wouldn't be able to cash anything out. So then you would just get credit for the 6 weeks that you sold. And, I don't know whether that would get you up to your limit yet. But that would, that's how you do that. Okay. Okay, so, and this is a follow-up to the question about the calculator. There's the worksheet here that you're seeing a piece of, that doesn't do any calculations for you. The worksheet is a static worksheet. You just plug in numbers. The place that you go to estimate your benefit is you go out to our website, you go to any page, and there's a login button here. You press the login button and you log in. If you've never done it before, you have to set up an account by clicking sign up. And then you have to answer some security questions. And then you can create the username and password and get in there and use the benefit estimator. Otherwise, if you've already done that, you just log in with your email and password. And once you get in there, you will be able to use the benefit estimator. And that is actually a programmed worksheet that has all the math programmed into it. Okay, great. And the PDF downloaded for you just now. Great. Okay, so that seems like all the questions about the vacation compensation. So tier 3 and 4 members, welcome back. Thanks for bearing with us through that explanation. It's, if you read the laws and all the court cases that govern this stuff, it's complicated. So I do my best to try to break it down for you and make it easy, but it does take a little while to explain all that. Okay, so let me tell you about the benefit limits to your monthly payments. And I'll just do this really quickly. These don't apply to a lot of people. A few people will hit these limits. Limit A is that you cannot have a retirement allowance that's higher than your highest average monthly salary is calculated to be. And basically that's trying to prevent you from earning more in retirement than you were when you were working. And which is mostly true, except for, as we just learned, your highest average monthly salary could be a little bit higher based on you being compensated for your earned vacation. So, but in general, whatever we calculate your highest average monthly salary to be, your retirement allowance cannot be any more than that. Okay, B and C are for people who have really high salaries, so I'm not going to spend any time on that. If you do have a high salary, I would recommend reading that information and then going out to our webpage at sara.org/limits and reading that information for yourself. Okay, now the last limit is that tier 4 members have a cap on how many annual dollars we are allowed to include in the salary calculation. And we cannot, like for general members for 2024, we cannot include any more than 151,446 annual salary dollars for calculating your salary for calculating your retirement. Tier 4, the law that created Tier 4 in 2012 limits it to the Social Security wage index limit. So That's the bad news. The good news is that what we do when you surpass those earnings in the year, let's say that happens in October or November, for example, is that for the rest of the year, we stop collecting retirement, your employee retirement contributions from your paycheck, and that leaves more money in your paycheck to perhaps save in your 457B account. So that's how that works. Okay, so at this point, I'm going to show you two ways to get a retirement estimate. I'm going to show you a very quick ballpark way. And I don't know, I always say very quick, but they're about the same speed because this way you got to do a little math. The other way, you just log into your account, plug in a couple of numbers and let it do the math for you. Why I like to do this first one, the reason I like to do it is because it shows you this chart of salary replacement percentages. And so I want to show you that. So what you're going to look at is this spot on your retirement planning worksheet where it says estimating my retirement benefit and getting a ballpark estimate. So all you do is you think of your plausible retirement scenario and you think, how old will I be in this scenario? Maybe I'm 58. And then how many years of service credit will I have when I retire at age 58? Well, I'll have 29 because I know how many I've worked so far, so I know how many more I will have achieved at age 58. Then you go out and you got to find where those numbers intersect on one of our charts. So you can type in acera.org/ballpark in your browser, and it will take you, it's a shortcut that takes you right there. I'll show you how to actually navigate to it. So you go on any page, including the homepage at Acera, you go under members and you go down to the third selection under the first category, members. It says planning your future retirement income. And this is a step-by-step process for people who are, planning on having and wanting to plan to have an adequate income in retirement. And step one is getting an Acera estimate. It gives you 4 ways. I'm going to show you these 2. The first one is you click on one of these ballpark. You click on one of these buttons for your tier, and this will open up the ballpark percentage chart. So I'm going to click on the general members tier 2. I usually use them as an example because I think like 80 or 90% of our members are general tier 2 members. And it's going to open up this chart. And then you look at your numbers that you wrote on the worksheet. So in this scenario, I was going to retire at age 58. So the age of retirement is across the top. Years of service credit is up the column on the y-axis. You go down to that scenario. So at age 58, I will have earned 29 years of service credit, and you find out where they intersect. In this case, they intersect at 50.03%. Okay. So that means that my retirement allowance when I retire in this scenario is going to be 50% of my working salary, which is pretty good percentage for just the Acera pension alone, because then if you're not a safety member and you're going to collect Social Security, you can add the Social Security to that and to get a higher percentage of salary replacement. Another feature of this chart is that you can see the effect on your percentage of salary replacement if you work another year more or another year less, or however many years more or less, by going diagonally. So if you retired a year after that, if you retired at age 59 and you have 30 years of service credit, you just go diagonally down and you can see that you would achieve 54.5% salary replacement. Work another year after that, basically 59.5% salary replacement. So that's why I like to show these ballpark charts, because it shows you the impact of working an additional year, working a year less, on how much of your salary you're replacing with your retirement allowance. Coming back to the worksheet, what you can do is you can plug that in. In this example, it was about 50%. And because this is a ballpark estimate, you just kind of think about your monthly salary now. You multiply the percentage by your monthly salary, that gives you a ballpark estimate. In this case, it's about $3,000. Okay, let me show you the precision benefit estimator. This is probably the way that you want to do it, because this gives you a precision estimate based on a very specific retirement date and based on all of the records we have for you in our pension database software. So this is another section of that worksheet. So you can fill in these blanks if you like. You can put in, and then you can, if you wanted to, you could just save the PDF that the benefit estimator produces in the same folder, or you could print all of them out and staple them together. So your choice. So you're going to go to, you're going to think of your retirement scenario, and you're going to put in two dates, a separation date and a projected retirement date. Your separation date is your last day on payroll. Your projected retirement date is your first day of retirement. And if you plan on going straight into retirement, these should be 2 consecutive days. Okay, so you're going to think of these dates, and then you're going to go out to our website, acera.org. You click the login button. You could also just navigate to acera.org/login, and it will take you right there. Okay, once you get there, you need to log in, username and password, and your username is your email address. Once you get in there, you'll start on an account summary screen, and you click Estimate a Benefit. This is our benefit estimator tool. You put in those two dates, your separation date and your projected retirement date. I'll zoom in here so you can see it a little bit better. Okay, in this scenario, this person is retiring in March of 2030. You hit Calculate. It is going to give you a projected amount of service credit you will have earned in this retirement scenario, where you're separating on this date and retiring on this date. Because it knows how much service credit you've already earned, because this is your personal account. So it's just going to take all of the time between now and then and add it to what you've already earned. And that's where your projected service credit comes from. It also gives you a highest average monthly salary projection, also known as final average salary, which is just two synonyms in our pension lingo. It makes the projection based on your current salary, if your current salary is the highest from your career, and then any pay periods in the future it needs to fill in, it will fill in with that current salary, the most current one that it has in the database. You'll see that in the estimate. It'll show you all of the pay periods that it's using to calculate this monthly salary projection. Okay. And then you hit Get Estimate. Oh, you can put in beneficiary information here, Get Estimate, and you end up with this PDF benefit estimate. This is your retirement estimate for the retirement scenario that you have plugged into the calculator. Okay. Now, one thing that I want to do is show you how to use, let me go forward. Let me go back. Show you how to use this field right here if you want to. Okay. If you want a nice conservative estimate, you leave this field blank. But if you happen to be curious about the effect that being compensated for additional vacation will have on your retirement allowance, like we just spent 15-20 minutes talking about, you could do that on this calculator. You can add in hours of vacation that you believe you are going to be compensated for, either through selling them in the future or getting cashed out for them in the future, the total, and you can put those hours in here. And then it will give you a higher retirement allowance estimate because you've added those additional hours, and then it will come through in the form of putting more salary in your calculation. So here's how to use that. On your worksheet, I've given you a section on there to help you calculate this and not overestimate. And the reason most people overestimate is because you've already sold vacation and it's already being included in there. Okay. So if you've never sold vacation before, you can basically put in any number in here up to your limit in hours. So if your limit in weeks is, let's say it's 2 weeks, you would put in 80 hours in here because you got to multiply it out. Or, if you work 37.5 hours per week, you'd have to multiply that out. Okay, so you're gonna want to convert it to hours. Okay, so the way to do it is to use this, the way to not overestimate is to use this part of the worksheet. Okay, first, we are going to transfer a number from the other part of the worksheet over to this section. And the number that we're going to transfer is your limit from the other part of the worksheet, your limit of the maximum amount of vacation compensation we're allowed to include for salary. Now, if you are working for the county, for what was it? The courts and the housing authority. Let me see here. Let me just verify this. County courts and housing authority. Your limit was in weeks, and so you bring the weeks number over to this section of the sheet, plug it in here. Now, if you work for AHS, your number was in hours, and so you just start here, plug your limit in hours here. If your limit is in weeks, you need to do the multiplication. You need to take your limit in weeks, multiply it by the number of hours you work, and then that converts the limit in weeks to hours, because that's how our calculator works. You need to plug in hours. Okay, then you need to subtract out all of the vacation hours for which you already sold. If you've never sold vacation, you sold 0, you plug in 0, and then this would be the number that you can plug in. Now, in this example, I'm going to give you, this person is going to go look at their retirement estimate and figure out how many hours they sold. Okay, so what you do is you do step 1 is you use the calculator and you leave the hours of cash vacation compensation field blank, and you end up with the regular retirement benefit estimate without the hours included. And then if you look on the pages after page 1, you'll see there is a list of all of the pay periods that it's using to calculate your salary. And if you sold any vacation, you'll see that listed here in this column, and you'll see how much you were compensated for it. That doesn't matter. It's just the hours that we're looking at. So you add up all those hours in that column, and let's say the person found that they had sold 40 hours on that sheet. You're going to subtract those hours out of your limit, because those hours are already being accounted for in this benefit estimate. And so if you did not subtract those out, you would be overestimating, and you would be sorely disappointed whenever it comes time to see what your real retirement allowance is. Okay, so you subtract them out, and then whatever you get, that's what you would put in this field if you want to see how much the maximum number of vacation compensation hours would be and how much it would boost your retirement allowance. Okay, so now that you have a retirement benefit estimate, whether you put in the vacation hours or not, what you're going to see here is numbers for the estimated amount you would receive every month for the rest of your life, depending on which one of the 5 different retirement options you select. And so that's right here. And this is what I'll talk more about that later. Okay. So really, if you want to, at this point, and you're filling out the worksheet as we go along, you could just put in the unmodified option number here, which is the highest. That's the one that most people select. But in a little bit, I'm going to tell you about each of the options, and that might give you a better idea of which option you might select. And so if you want to, you can record the, what the precision estimator gave you on your worksheet, or you could just take this PDF, like I said, save it in the same folder, or print it out, staple it together with the worksheet. And, that gives you all the numbers. Okay, there is one more way that you can get a retirement benefit estimate. You can ask us to do it. We'll do all the work for you. You find the retirement estimate request form out at acera.org/forms. The one thing I'll tell you about this is there's a wait time, there's a queue. And so it could take some weeks for us to do it because there's a lot of people in the queue. And then additionally, they're going to use the same math and the same software as the benefit estimator. It's going to come out to the same, and you can make one of these in 5 minutes or less once you get logged in there. So I recommend just doing that, just using the online tool. Okay, let me see if I have any questions on all this. Okay, so there was that one question during the break time that I answered, but I'm not sure if you heard the answer. So basically the question was, if I get a raise in March, and it'll be coming on, okay, I didn't understand this before. It's coming in your last paycheck. How will it count toward your retirement, or would it count? you're looking at 78 pay periods of a certain 77 pay periods of a little bit lower salary, and then one pay period of a little bit higher salary if you're in tier 2 or tier 4. So it's not going to boost your retirement allowance by that much by getting that raised. You'd have to wait another 3 years if you're in tier 2 or 4 before it would have, or maybe a year and a half before it have much of an effect. And you probably don't want to do that if you're already ready to retire. So sorry about that. Okay, next question. If one's average highest salary is with another organization that you've reciprocity with, do you just type that number into the salary override box? Yes, that is a good use of that box, because if you already happen to know what your salary was, and it's higher than what you were making here, that is a good use of that box. You could override your salary number, click get estimate, and that is a more precision estimate of what you will actually get from a SARA. Yes. Okay, so next question. Okay, the question is, in the year I plan to retire, do I have to wait for the month I started with accounting to get credit for that year? No, you do not. You retire when you want to, when you're ready. You don't have to time it based on when you started work. In most cases, there may be, and when I show you the other benefits, the healthcare benefits, there may be a reason you might want to get over the 10-year mark or the 15-year mark or the 20-year mark if you're close to one of those. And I'll talk about that in a little bit, to get the subsidies that come with those years. Otherwise, you just retire when you want, and you're earning service credit from your date of entry into a SARA all the way up until the minute that you stop working on your termination date. Even if it's, 17.87526 years, you get all those decimal places in the formula for you. And so all of your service credit counts all the way up until the final minute that you stop working. And then there's a question, can you repeat the vacation hours again? Maybe you could be more specific on what you were wanting me to repeat. I don't know if I have time to repeat the whole 20-minute explanation, but if there's a part of that you're still curious about, I'm happy to answer that. And then the next question is, how does deferred comp factor into the pension? And the answer is it does not. They're two different systems. So what you earn from a SARA is based on not how much you contribute to the fund. You'll remember the retirement formula is age factor percentage times years of service times highest average monthly salary. Your contributions to the fund have no bearing on what you achieve as a retirement allowance. It's only based on your age of retirement, how many years you've worked, and what your salary is. And that's how a SARA works. We send you a check. Now, separately, some of you may be saving extra money in a 457B account through the deferred compensation program that your employer offers. And all 6 of our employers offer that. So separately, you would then, in retirement, be able to take withdrawals from that deferred compensation account to help pay for your expenses in retirement. My colleague, Gene Hilliard, who does not work for a SARA, he's a consultant for Alameda County. He is going to do a presentation at 12:15 to 1 o'clock for 45 minutes on the deferred compensation program, and he will take a deep dive into that. Okay, and then you're saying hours of cash vacation. Oh, okay. Are you asking me to explain this bit again? Got it. Okay, here's what you do. Okay. This is real simple. Step 1, you run an estimate. Leave this blank. Okay, you get out to the benefit estimator, you leave this blank, hit get estimate. You end up with a PDF. Okay, then you come over to the worksheet, you plug in your limit from the other part of the worksheet that we already figured out, your limit of how much vacation compensation we're allowed to include as salary for the purposes of calculating your retirement. In this example, it was 6. You just transfer the number over 6 weeks worth. And that's if you work for the county, the courts, or the housing authority. Then you put in your weekly work hours, you multiply them together, and that converts your limit from weeks into your limit in hours. If you work for Alameda Health System, you simply take your limit in hours from the Alameda Health System section of the sheet, transfer it down here. Then you take that estimate that you ran where you left the hours blank, and you go to page 2 and page 3 and 4, because it will have all the pay periods it's using, and you look at the sold vacation hours column. If there's any numbers in there, you add them all up and plug it in to this field here, because you need to subtract out the hours of cash vacation compensation it's already including in your estimate. Then you take your limit, subtract it out. 240 minus 40 is 200. And this would be what you put in the hours of cash vacation compensation field, or up to that. If you know you're not going to get up to that, if you only have 2 weeks worth of vacation on the books, you just put 80 in here. Okay. And that's how that works. Okay, so moving on. Okay, let me see. There's a few other questions in here. Does the Sarah have a link to the various MOUs? You're with Acmea, and they haven't had a contract for the past year. I don't think we have a link to the MOUs out on our website. So that would be something that you would want to check with your human resources department on. So sorry about that. Next question. Okay, I see. That was just a follow-up. You're welcome. Let's see. There is a question. And the question is calculating your vacation, your limit on vacation. You're still confused by that. Why don't why so maybe you could give me more information. Tell me what tier you're in. Tell me how much vacation you earn per year. Tell me how much vacation you're allowed to sell per year. And I can tell you what your limit of vacation compensation is. So what your tier is, how much vacation you earn per year, and how many weeks of vacation you're allowed to sell per year. Okay, next topic. Verifying your retirement eligibility. This is a short topic. What we're talking about on the pension milestone chart is this date right here. This is the day that you're first eligible to retire, and you could retire this day if you want to, or you can keep working after that and earn more credit toward retirement. Okay. And I do see a raised hand there. We're just using the Q&A feature today, so feel free to go ahead and type your question into the Q&A. Because the raise hands feature is a little inefficient for the amount of people that we have in the webinar, so I apologize for that. Okay, so retirement eligibility. When are you actually eligible to retire? What does it take to get eligible? Okay, so I'm going to show you tiers 1, 2, and 3, what the different combinations that get you to retirement eligibility are, and then I'll show you tier 4 on the next slide, because they're a little different. Okay, if you're in tiers 1, 2, and 3, you have 3 different combinations that get you to retirement eligibility. Option number 1 is that you are at least age 50, and you have at least 5 years of service credit, and you have at least 10 years of membership with Acera. Now, tiers 1, 2, and 3 closed over 10 years ago. So everyone in tiers 1, 2, and 3 already has at least 10 years of membership with Acera. So you don't even have to think about that. You just have to be age 50, and you have to have at least 5 years of service credit, and you can retire if you want to. Option number 2 is, as a general member, you can have 30 years of service credit, or as a safety member, you can have 20 years of service credit or more, of course, and you can retire at any age, even if it's younger than age 50, that you would get in option 1, that you would have to meet for option 1, I mean. Your third combination is that you can have any amount of service credit and be age 70 and retire. even if the amount of service credit that you have is less than the 5 years you need for option number 1. So you could have 4 years of service credit, or 3 or 2 or 1. As long as you're age 70 or older, you can retire. Now, with those low amounts of service credit, your retirement allowance from a SERA is going to be rather modest, but it's still a lifetime payment that you get every month. And if you do have a service credit amount that is, on the lower side like that, it's will probably still pay for a bunch of your bills in retirement. And presumably you have some other income to help pay for your retirement. Next slide is how do you become eligible for retirement if you're in tier 4? Okay, so this is for the tier 4 people. You have 2 different combinations. Option number 1 is that you are at least age 52 as a general member, or at least age 50 as a safety member, and you have at least 5 years of service credit. You can retire. Option number 2 is that you are at least age 70 and you can have any amount of service credit, even if it's 4 years, 3 years, 2 years. That's fine. As long as you're age 70, you can retire. So the requirements for tier 4 are a little bit simpler. Okay, now that you know when your retirement eligibility date is roughly, you could type that in here or write that in here if you want, because it's whenever you reach the earliest one of these combinations. If you already happen to know that you're eligible to retire, you don't have to think back to when was my retirement eligibility date. So you don't have to worry about that. This would just be for really if your retirement eligibility date is going to be in the future. You could keep track of it here. Okay, let me get back to that one question that's still up on the board. Your tier 2, it seems like you have 88 hours of vacation on the books that you could possibly sell. But let me ask you, how many weeks of vacation do you earn per year? And how many weeks of vacation are you allowed to sell per year? Because it says you work for Alameda County and you've been here for 7 years. So I'm guessing that you earn 3 weeks of vacation per year. Let me know if that's true. Because I think after 5 years where you earn 2, then you move up to earning 3. Let me know if that's true. Okay, great. And then how many are you allowed to sell per year? So your employer has a rule that your payroll clerk can tell you, and it's maybe you're allowed to sell 2 weeks per year. You're allowed to sell 3 weeks per year. We need to know, you're allowed to sell 15 days. Okay, so you're allowed to sell 3 weeks per year, and you're in tier 2. You earn 3 weeks per year. You're allowed to sell all 3 weeks. So the lesser of 3 or 3 is, of course, 3. Your limit of how much vacation compensation is 9 weeks. So 9 weeks worth, 3 plus 3 plus 3. So you have 88 hours on the books right now. And what is 88 hours? About two plus weeks. You're in the pre-retirement webinar. You're getting ready to retire. Maybe you could let me know when you're planning to retire. And this can kind of be as an example for everyone. Retire this coming March. What is the 240? You say you have 240. What is that? Oh, you have 240 hours of vacation saved up. Okay. Got to get out my calculator here. Okay, so 240, and it sounds like you work 40 hours per week. Divided by 40 is 6 weeks. Okay, so you have 6 weeks now. You on the books. Where are we at? November? Okay, so what do we got? December, January, February, March. That's 4 months. So that's a third of a year. So you're probably going to earn you earn 3 weeks per year. You're going to earn another week. So you're probably going to have 7 weeks by the time you get there. So if you don't take a vacation between now and the time you retire, you will have about 7 weeks on the books, which is under your limit of 9. And so you will get a 7-week worth of salary boost to your salary for the purposes of calculating your retirement. So that'll be pretty good. So I hope that answers your question. Okay, so let me help you choose your retirement date. Oh yeah, you're welcome. Let me help you choose your retirement date. And if anybody else wants to go through that exercise, let's do that like at I'm happy to do that for you if you're still confused, and we can do that at 1:00 whenever the deferred comp presentation is over. Okay, so next topic. But thanks for that example. I think that was a good illustration for everyone. Okay, so choosing your retirement date, how to do it, what date to choose. This is a date that you choose. We don't tell you when you're retiring. It's not based on some amount that you earn and then you get retired. You choose when you're retiring. And so there's probably a few things you want to think about choosing the best date to retire. Okay. So here's the list. There's 6 things that I'm going to go through. I'm going to go through each one. I'll talk about the age factor percentage dates. I'll talk about the cost of living adjustment, and so on and so forth. First topic, will you have enough income? This is something that is, optional to think about. Excuse me. It's a, good thing to think about to just kind of get a little window into the future to make sure that you have enough income to maintain your standard of living. So what you would want to do is go ahead and do that Semianr retirement estimate using the estimator in your online account with the Semianr. If you have a deferred compensation account, a 457B account, it's a good time to log into their website, see how much you have in there, get an idea of like how much money you might have to spend in retirement. And then if you stay around for the deferred compensation presentation at 12:15, Gene Hilliard is going to explain to you how you figure out what amount of disbursements you might want to take per year from deferred comp if you're trying to time it out so that you're taking a certain amount out that kind of covers the rest of your lifespan. So he can do that. He can help you with that. Okay. It's also a good time to get an estimate from Social Security, and you can do that on their website. They have a similar tool that we do, and they will give you a very specific estimate on how much they plan on paying you when you achieve the different ages that you might collect Social Security, starting at age 62. If you want to, this is kind of extra credit. You could look at your possible income in these, all the categories, and you could add in any other investments that you have. And then you could compare what your retirement income would be with a calculation of your retirement expenses. I mean, it's that, that's kind of a task, but you could sit down and do that if you want. And we actually have some tools out on our website that you can do that. The very shorthand version of figuring out whether you will have enough income to maintain your standard of living is simply by calculating how much income replacement what percentage of calculating your income replacement percentage. What percentage of your working salary are you going to be replacing with your retirement income when you add up all of the categories of income that you're going to have? And it should be about 70 to 80% is what financial planners will tell you in order to maintain your standard of living. Now, we have an expanded article about this out on our website. Let me orient you to that. Okay, on our homepage, there is this section down here, this berry colored section that says ready to retire. And there's links in here to various articles on our ready to retire section. One of them is estimate your retirement income. So you can just click on that. And this article takes you through a step-by-step process on doing what I was showing you on the slide. It has a link out to your Semianr pension tool, a link out to the Social Security tool. I got to change this. It's now Empower. So Empower took over for Prudential. So If you want to log into your account over at Empower, there's a link there, which I'll change right after this webinar. And then when you come down here, you can actually do some of that, extra credit stuff. There's an AARP retirement calculator that we are linking you to. That's an extra kind of technological tool that you can use. And there's even a budget worksheet that you could use to calculate your retirement expenses if you want to sit down and do that stuff. Otherwise, you just take all your income and add it up and see if it's going to be replace 70 to 80% of your working income. And if it's not, then you have the option of working longer, or you could move somewhere that's cheaper so that you have less expenses. Or you could just live with a lower standard of living. Okay, number two. The number two thing that you're going to want to think about and consider when choosing your retirement date are these age factor percentage dates. So I mentioned that you may want to think about these when I was talking about the age factor topic in the first part of the presentation. Okay, so if you recall, what I told you was that as long as you are younger than the maximum age for your tier where you get the maximum age factor percentage, that means that every quarter year that passes that you don't retire yet, you are going up one notch in that age factor chart. Do I have a screenshot of the age factor chart? Yeah, here it is. You're going up one notch in the age factor percentage chart with every quarter year that passes that you don't retire. And remember, I said it's based on your birthday. So the quarter years give you a slightly higher percentage incrementally. Okay. So going back to here, let's take the example of the January 15th birthday again. One quarter after January 15th is April 15th. Then July 15th is 2 quarters after. October 15th is 3 quarters after. So let's say that you are younger than the maximum age factor percentage for your tier. And so your age factor percentages are still going up when you pass these quarter year days based on your birthday. And let's say that your birthday is January 15th and you're thinking about retiring on July 14th. Well, you're probably already getting the idea that you probably don't want to do that. You would want to retire on July 15th. Just wait one day. Because if you do that, you go up one notch in that age factor percentage chart. Your age factor percentage that we put in the formula for you gets a little bit higher. And in fact, it would increase your retirement allowance by somewhere over 1%, somewhere between 1% and 2%, just by waiting that one day, just by knowing what these dates are and knowing not to retire right before one. And the same is true with all of these dates. Okay. And basically the bottom line here is I'm not trying to tell you that you need to retire on this day right after the quarter year day passes. I'm just trying to get you to not retire right before one. Like if you were going to retire midway between April 15th and July 15th, like May 15th or something, in this example, that'd be totally fine. I mean, because you don't want to wait another month and a half before July 15th passes. Or what is it? What would that be actually, like June 1st, a month and a half before July 15th passes? You're ready to go. You're not going to wait around another 6 weeks to get that next highest age factor percentage. That's fine. Just don't retire right before one of these days. Just, push it out a few days, get past that day if you're going to retire in around one of these dates. And again, it's based on your birthday. So it's not necessarily the 15th. If your birthday is January 6th, then it would be April 6th, July 6th, October 6th, and so on and so forth. So basically that's all I'm trying to tell you with that. Okay, second topic, cost of living adjustment. Remember, this is one of the guaranteed benefits. This is an annual increase to your retirement allowance. So I always say that your retirement allowance when you retire is whatever it's calculated to be at the time of retirement. That's what it's going to be for the rest of your life, but plus cost of living increases. And it's a percentage increase that you get every year based on the consumer price index for the San Francisco Bay Area. Basically, this is a measure of inflation that is provided by the federal government. If the CPI goes up in the Bay Area from December to December, a certain percentage, let's say it goes up 5%, that becomes the cost of living number that we're increase number that we're looking at. And we pay that to all retirees who are in retired status on April 1st of every year. So if this is going to be your first time that you are retired and you're going to pass April 1st, that means that you need to retire on April 1st or before April 1st to get that year's cost of living increase. If you retire on April 2nd, you will miss that year's cost of living increase, but you'll get next year's cost of living increase on April 1st when April 1st comes around, and every year after that for the rest of your life on April 1st. Okay. So there has to be a cutoff on one day, and it's April 1st. Now, regarding the cost of living increase percentage, changes from year to year, but like I was giving the example of 5%, we actually couldn't pay you 5% increase in a particular year because the law has a limit written into it. For tiers 1 and 3, it's a maximum cost of living increase of 3%. For tiers 2 and 4, it's a maximum cost of living increase of 2% per year. Well, in the example I was giving you, inflation was 5%. So what happens to the rest of the percentage points? Well, they don't just disappear. We will actually save those percentage points for you in what we call a COLA bank. And in future years, if inflation is less than your maximum, like let's say next year comes around and inflation's only 1%, we'll take percentage points out of your COLA bank to get you up to whatever your maximum is. That happens automatically. You don't really have to think about it. You don't really have to even remember that COLA banking exists after this presentation. Kind of the bottom line here is that if you've already been retired for a few years and you've collected a few percentage points of inflation in that COLA bank, you will tend to get in tiers 2 and 4, 2% every year, and for tiers 1 and 3, 3% every year. And that's just kind of the way it works out because inflation tends to be more than 3% in the United States. So over time, you will be collecting percentages in that COLA bank. Now, the fourth thing that you're going to want to think about, possibly, if you're in a certain scenario, when you are choosing your retirement date, is if there's a conflict between the age factor percentage cutoff dates and the cost of living date of April 1st. Okay. So to give you, let's stick with the January 15th birthday example, for continuity. Let's say that your birthday is January 15th. You're a general member, you're age 54, and you're going to retire. And the reason I'm using this example is because this person is still younger than the maximum age factor for their tier. So that means every quarter year, their age factor percentages are still going up, and they know that they want to retire in the spring. Okay, so they're considering two options. Should I retire on April 15th, which is 1 quarter after my birthday? And in that case, I would get the age factor increase for for achieving the age of 54 and a quarter, basically. But I would miss the cost of living adjustment that was paid to people who were retired back a couple of weeks ago on April 1st or before April 1st. Should I do that, or should I retire on April 1st? And then I'm going to miss the age factor increase that's going to come in a couple of weeks by retiring on April 15th, but I will get the cost of living increase by retiring on or before April 1st. What should I do? Well, you probably already know what the answer is because I gave you all the percentages earlier, but if the cost of living adjustment is the maximum, and you can tell this on our website, in early February, we post whatever the cost of living increase is going to be for the upcoming April 1st, then you would go with the cost of living increase because you would get an immediate 2% or 3% increase, depending on your tier, to your retirement allowance versus the increase that you would get from the age factor percentage, which is somewhere between 1% and 1.9%. Now, if you don't, you could, if you're wondering about this, you could use this slide to go by. The other way that you could do it is you do 2 retirement benefit estimates on our website. You would do one for April 1st. You would do one for April 15th. The April 15th one, the estimator is going to already calculate the age factor increase. For the April 1st one, you would just need to multiply it by increase it by 2% or 3%. So you multiply it by 1.02 or 1.03. And then you can compare them and see which is more and choose whichever one is more, because you should get the maximum retirement allowance if you can. Okay. Two more things, numbers 5 and 6, two more considerations for choosing your retirement date. Okay. Now, this is going back to the topic that we were talking about at the beginning of the presentation about the sick leave conversion to service credit. If your plan is I'll take a step back. If your plan is to stop working and defer your retirement to a later date, you don't even have to worry about this. Okay. And in fact, I recommend going to our website, typing in acera.org/defer, which is acera.org/DEFER, and there will be some information for you about retiring out of deferred status. Okay, let's say you're not doing that. Let's say that you want to go straight from active work to retirement, and we will do the sick leave conversion for you, so you'll get half credit for your unused sick leave up to a cap. Here's how you do it. Here's how you arrange your retirement date. You are going to retire on the day after your last day on payroll. Okay, this day, and what you're seeing in this graphic illustration is their last day of work is on the 24th. Their first day of retirement is on the 25th. They're two consecutive days. There's no gap in between these days. Okay. The 24th in this example, this is the day that you write on your letter of resignation. And we actually have a letter of resignation out on our website on our, if you go to acera.org/retire, which is the last step in the retirement process, it has our electronic retirement packet on it. There is a letter of resignation that you can use. You can just type in your information and you provide that to your employer. And this is the day that you say you're resigning. This is your last day on payroll, also known as your termination date. It's okay if you're on leave this day, if you're on vacation leave, on sick leave, whatever. You're using up a floating holiday, whatever. This is just your last day on payroll. Your retirement date is the day that you write down on your retirement application, which I'll show you in a few minutes. That means those are two consecutive days, and we will do the sick leave conversion for you automatically, and you don't even have to think about it, because the bottom line here is you don't want a gap between these days. The next, number 6, is related. You're going to want to retire on a day where you're scheduled to work on the day before, which should be a non-holiday. Okay. For example, if you work Monday through Friday, your first day of retirement should not be Sunday or Monday because you don't normally work on Saturday or Sunday. So if you work Monday through Friday, your first day of retirement can be Tuesday, Wednesday, Thursday, Friday, or Saturday. So the next day after a day that you're scheduled to work. If you work in healthcare, or you work in law enforcement, there is a good possibility you don't have a regular schedule like that. And in that case, you might want to pick a retirement week. And then when it gets closer to your retirement week that you've targeted, and they actually print the schedule or show you what the schedule is, then you have the ability to choose a retirement date that is a day after a day that you're scheduled to work. And again, the last day that you're scheduled to work should not be a regular, county holiday. So you don't want this day to be the Friday after Thanksgiving. That's a county holiday. So, pick any other day that's a non-holiday. Okay. So on your worksheet, now that you know that what your projected retirement date might be, and let me clarify that. Now that I've given you a lot of information about how to get a retirement projection, like how to get the benefit estimate, how to choose your retirement date, kind of the ins and outs of that. If you have in mind a very particular projected retirement date, you could go ahead and write that in on your worksheet as your projected retirement date target. And then if you are someone who's trying to go from active work into retirement to get the sick leave conversion to service credit, you simply know to take your projected retirement date, subtract a day, and that is your last day on payroll. And again, just make sure to go by the guidelines that I'm giving you on 5 and 6 when you're choosing those two dates. Okay, next topic. Oh, and let me see, there's a question up here. Okay. Interesting question. So the question is, does taking the Acera retirement trigger any requirements with Social Security? Like, do you have to take Social Security? Like, let's say the example you're giving is, let's say you retire at age 62 from Acera, and you could at that point take the Social Security starting at age 62, but you don't want to. You want to save it for age 67 to maximize those payments. Yes, you can do that. So Acera, retiring from Acera does not trigger the requirement for you to um, retire from Social Security. Okay, and then there's a question. How does scenario number 5, retiring from the last day, affect those who have reciprocity? Okay, let me think about this. So if you have what we call incoming reciprocity to Acera, which means you used to work somewhere else and you now work for one of our employers, this would apply to you. So you would want to make sure to do this because you probably have sick leave on the books that you want to convert to service credit. If the opposite is true, if you are a deferred member with Acera because you've already gone to work somewhere else, and you're in active status somewhere else, and you have reciprocity where the systems are linked together, this does not matter to you because you've actually already lost all of your sick leave from your Acera employer. So whenever the only way that you get any credit for sick leave when you stop working is to go straight into retirement. Otherwise, if you terminate your employment for any reason and don't retire immediately, even if it's just you terminate your employment, one day goes by and then you retire, you lose all your sick leave. So that's why I stress you go straight from active work into retirement with no gap for the people who are trying to have us do that sick leave conversion. But otherwise, you already lost all your sick leave, and you can just, I mean, sorry about that. You can just kind of write it off in your mind, and those are just the rules that the employers came up with. It's probably to inspire people to hang around in employment for our employers longer, is I imagine why those rules are in place. Okay, so applying to retire. Oh, and then there's a question about the COLA. Let me see if I answered that. That's been up on the board for a while. Oh, I actually answered exactly your question about it was this dilemma. So yeah, that hopefully that answered your question. You just go by whatever is the highest percentage, what's going to give you the most retirement allowance because your birthday is in January, and that's how you choose that. So yeah, I did actually that exact example. Let me know if you have any follow-up questions to that. Oh, okay, great. Thanks. Okay, so the retirement application process. What do you actually have to do to retire? You have to take a little bit of action to do this. We can't read your mind. And we have created a process for you that makes it easy for you to retire. Okay, so here's how you do it. Step 1, we want you to go through our preparing to retire section at acera.org/prepare. Let me change the share over and show you that section. Okay, so you can either type in acera.org/prepare, or I'll show you how to just navigate there so you don't have to do any typing. Go to acera.org. Come down to this berry colored section, ready to retire. Hit prepare to retire. Okay, now this is a chronologically organized section that has the things that you probably are going to want to do before you retire in order to prepare for retire. Now, it may look like there's a lot of stuff in here. You've actually already checked off a lot of these boxes. We've already verified your retirement eligibility, okay? Maybe you don't have any service credit to purchase, or you're not going to do that, or you've already done it. Okay, so you can read that. Understand how vacation pay affects your pension. We already covered that in the seminar. Estimating your retirement income. Well, that only takes about 5 minutes, as we've shown by logging into the website. attending the pre-retirement seminar. You're doing that as we speak. So check. So you're already halfway through the section. There are a few more things. Choosing your retirement date, like we've already covered that. So there's just a few more things that we want you to go over. And then the last two steps are important, and I'll show you that back on the slide. Okay, so go through this preparing to retire section. Step number 2, set up a ready to retire counseling session. And we highly recommend this. It's not mandatory, but we highly recommend it. And it makes it so that you're fully prepared to retire. And we start getting the gears turning in our calculations and our preparation for your account early so that you have a smooth transition into retirement. So you can either navigate to acera.org/counseling, or back on that preparing to retire page, it's the second to last step. They both go to the same place. Okay, schedule a ready to retire counseling session. And you do this timing-wise 3 to 6 months before retirement, the 3 to 6 month period before your retirement date. And what will happen is you fill out this form. It's not very long. You answer a few questions, hit submit. We'll get your submission. We'll contact you to set up the ready to retire counseling session for the 3-month period before your projected retirement date. So you'll get counseling within that 3 months right before your retirement date. Okay, so that is step number 2. Step number 3 is where you submit your retirement application. And you do that within the 3-month period before your retirement date. Now it's showing you a URL here, acera.org/retire, a link. That is actually the last step on that preparing to retire page. So I'll go back to the preparing to retire page just to orient you to where all this stuff is. Applying to retire. So this is the last step. It takes you through some stuff you've already done just to be totally sure that everybody's got everything under their belt that they need to do. You've already done this counseling session at this point. It will tell you about the 5 retirement allowance options, which I'm about to tell you about. And then there is an electronic retirement packet, and it's all through DocuSign. So you just click the button, you fill out the retirement application in DocuSign, you hit submit. And on the retirement application, you're doing 2 things. You're choosing at least 2 things, but 2 main things. You're selecting one of the 5 retirement allowance options, and you're choosing your retirement date definitively on the application. You hit submit, we process it, we'll note your retirement date into our system. Once your retirement date passes, you're retired. It's going to be freaking amazing. You've earned it. Thank you for your service to Alameda County. It's going to be just incredible. So, yeah. So your retirement date passes, you're retired. Then you start collecting that retirement that you've been earning. You earned it. Okay. So going back to our worksheet on the My Career Timeline, if you want to, now that you know that you are going to submit the Ready to Retire counseling form 3 to 6 months before your retirement date, you could simply take your projected retirement date, subtract 6 months, and write that date in there. And maybe make a note of that in your organizer or your digital calendar. Okay, now what can you expect once you're retired? Well, you're going to start getting paid the retirement that you've earned every month for the rest of your life. But the first check is going to be a little bit slower. It'll come 4 to 6 weeks after your last employer's paycheck. So there will be a little lag time after you stop working. You'll get your last employer paycheck. Then it'll be 4 to 6 weeks after your last employer's paycheck. In 99.9% of the cases these days, because we have implemented this ready to retire counseling session policy, that means that 99% of the time people get right on their 100% payment. Everything's in order. We've calculated everything correctly. You get your 100% payment immediately. Now, if there's any major issues with your file, we will start issuing you 80% payment so you have some income. And then once we get everything resolved, you'll get your 100% payment plus any retro payments we need to do. Okay, there's a question. You currently work for another agency and you have reciprocity with Alameda County. Do you get the medical benefits from the current agency or from Alameda County? Well, it depends on how much on what they offer and what you're eligible for. And I'll talk about the eligibility for the medical benefits right after I do the retirement allowance options. The medical, vision, and dental stuff is the last thing I'll do. But basically, if you are eligible for benefits in both, you could, you have your choice. And I'll talk about that in a few minutes. Okay, now, what I want to tell you about in detail is about the 5 retirement allowance options. They have names: the unmodified option and options 1 through 4. Okay, now on your retirement application is where you're choosing these options. And you're only going to choose one. And this is your opportunity to choose one and your only opportunity to choose one. You can't pick a different option later. So it's good to understand what they are and what they do, so you can make an educated choice now, because you can't change it later in retirement. There is one scenario where you need to apply for disability retirement, which is a separate process. And if you want more info on that, you can go to acerra.org/disability. But you can't, you're disabled and you can't work. So you take the regular retirement, and then you have that while you're waiting for the disability retirement to see whether it's going to be accepted or not and approved by the board. If it is approved, then I think you may have the chance to change your option. You would want to check with our disability unit on that, though, just to be definitive about that. Definitively sure. Okay, so let me help you choose between these options. And when you see these slides, it might seem complicated at first because there's a bunch of text on here, but I'm going to walk you through all this stuff. Okay, so I'm going to show you 5 slides, one for each option. The top is going to be the title of the option. What you're going to see at the first row of the table is going to be information about what you will be paid as an ACERA retiree. It'll be information about your retirement allowance, your pension benefit. The bottom information is going to talk about what your beneficiary or beneficiaries will receive after your death, if you choose that option. Now, to give you a definition, because I actually didn't used to know what this word meant, beneficiary is just somebody who gets benefits. So your ACERA beneficiary is somebody who you designate to get your ACERA death benefits after your death. So you pre-designate them while you're still alive, and they will receive your death benefits after your death. Okay, so let's jump right in here. I'll explain the first option first, the unmodified option. This one pays the maximum retirement allowance of any of the 5 options. That is why, I assume that this is why. I guess I've never asked anybody about it, but that's why the vast majority of people choose this option. It just pays the highest retirement allowance of any of the options. Okay. Now, that's your retirement allowance. It's the maximum of any option, any of the 5 options. Okay, what does it pay to your beneficiaries upon your death? Okay, so if your beneficiary are certain people, if your beneficiary is your spouse or your state registered domestic partner or your Alameda County domestic partner, who you have filed the Alameda County affidavit with to the county as your domestic partner, after you retire and after you die, they would receive a 60% monthly continuance. Now, the continuance, that word just means a continuing payment. So you, as a living retiree, are getting a monthly payment every month for the rest of your life. Then, in this scenario, you die, and your beneficiary receives a continuing monthly payment for the rest of their life. If it's a spouse, state registered domestic partner, or Alameda County domestic partner, as long as you have married or registered them or filled out the affidavit with Alameda County at least 1 year before your retirement, they will get a 60% continuance. If you apply for and are awarded a service-connected disability, it would actually be 100% continuance. Now, if you don't have a spouse or state registered domestic partner or Alameda County domestic partner, but you do have minor children, a minor child or minor children, you could name them for the 60% continuance, but it's not a lifetime continuance. It's temporary, and it will stop it when they reach age 18. It could continue past 18 as long as they maintain enrollment as a full-time student in an accredited school, and then it can continue until age 22, which point it will stop. Unless At some point during that time, they get married or they register a domestic partner with the state, and then it will stop. Okay. Now, that's the continuance part of it. There's a lot of people that take the unmodified option that don't have any of these people to name as a beneficiary, and that's perfectly fine. You can name anyone else you want as your beneficiary. Now, they can't receive a continuing payment, a continuance. They will only be eligible for a one-time lump sum payment. And the one-time lump sum payment is going to be basically, we're going to give them back the balance of your Acera contribution account. So however much money is left in the account, we give it back to them. And that is going to be all of your employee contributions that you paid into the account throughout your entire career, plus all the interest that has accrued on that money over the years that we paid in your account, minus all of the retirement allowance payments we've already paid out to you because you're an Acera retiree and you're getting a monthly payment. And I will tell you that in the first 3 to 5 years of you being an Acera retiree, we're actually going to pay out to you the entire balance of your contribution account in the first 3 to 5 years. So if you were to select the unmodified option, name a lump sum beneficiary, and die after, let's say, 5 years, like 6 years later, there would be no balance left in the account to pay out as a lump sum. Now, there would be some other lump sum payments, some other smaller ones, like a partial month of your retirement allowance that we haven't paid you yet because you died halfway through the month. If you prepaid our medical premiums, you would get a refund of that. There's the $1,000 lump sum death benefit. So they would still get some smaller amounts, but there would be no balance left. So that's kind of the bad news of that. The good news is that what that means, the implication of that means that everything that you paid into the retirement system throughout your entire career, whether you worked 15, 20, 25, 30, 35 years, you get all that money back within the first 3 to 5 years of retirement through those monthly payments. And then everything after that, it's almost like this magical bonus that you get, but it's not magical because it's all based on math and it's all based on us running a secure retirement system where you get a guaranteed payment you can count on for the rest of your life. And the reason that we're able to do that is partially through your employer contributing. So the employer contributions get paid out to you as well. But 75% of your lifetime retirement allowance is actually based on the interest that we earn because our $10 billion fund is professionally invested by our investment team. So that's my little aside about how amazing the defined benefit pension plans are, like Acera. But what that means is that feel free to select the unmodified option just based on the retirement allowance. Okay. Now, one more thing I want to point out about the unmodified option is that there is a scenario where you go to retire, you select the unmodified option, you select a continuance beneficiary, and you retire, but then in retirement, your beneficiary dies before you do. You can, at that point, name a new beneficiary, but only for lump sum payments. So your only opportunity to name a continuance beneficiary is at the time of retirement on your retirement application. And that's just the way the laws work that the county has adopted. And this includes people will ask, well, what happens? I don't have a spouse now, but what happens if I get married after I retire? Same thing. You could name your new spouse in retirement as a beneficiary, but only for lump sum payments. And that's true with any of the 5 options. The only time you can name a continuance beneficiary is at the time of retirement. Okay. Before I take your question, let me go through all of the options, and I'll take your question after this section is done. Okay, so that's the unmodified option. The other options are a little less complicated. Option number 1 is the only option of any of the 5 that never pays a continuance to anyone ever. You can name a beneficiary, but it's only for a one-time lump sum payment. Okay, so what it pays to you, the retiree, in your retirement allowance is a little bit less than the unmodified option. When you run the benefit, do the benefit estimator, you'll see it's a little bit less. What this does is it extends the time that there is a balance left in your contribution account from 3 to 5 years to 10 to 12 years. So if you were to die within the first 10 to 12 years after retirement, there would be a balance left over to pay out to a beneficiary. And so the reason that people usually select this is that they don't have a continuance beneficiary. So they want to name somebody for a lump sum, and they're okay with a little bit. It'll be like $5, $10, $15 less per month than the unmodified option. And they do want to extend the time that there would be a possibility of leaving a lump sum to a lump sum beneficiary. And you can name anyone as a beneficiary. Okay, that's option one. Option two is titled 100% to the beneficiary. So this is in contrast to the unmodified option, which is titled subtitled 60% to beneficiary. This is subtitled 100% to beneficiary. So this does a couple of things, okay? One of the things that it does is it expands the group of people that you can name for a continuance benefit. Okay, so you can actually name anyone for a continuance, anyone as a beneficiary for continuance. It doesn't have to be spouse, state registered domestic partner, Alameda County domestic partner, minor children, or any children. But in fact, you could name them if you wanted to leave them a 100% continuance, because that's the second thing it does is instead of leaving a 60% continuance of whatever you were getting paid at the time that you die, whatever your retirement allowance was, and they get 60%. Instead, they get 100%. They get exactly what you were making in your retirement allowance for the rest of their life. And if you're naming a minor child, it would be for the rest of their life. And instead, it would not have a cutoff. Okay, now the caveat is that the amount that it pays less than the unmodified option is based on your beneficiary's life expectancy. So if you would name a minor child for that, we expect them to live a long time based on the actuarial tables. So we're going to go ahead and reduce your benefit by a lot. And this reduction is part of the retirement calculation. So this reduction is at the time that you retire. Remember I said earlier that whatever we calculate your retirement allowance to be at the time of your retirement, that's what it's going to be for the rest of your life, plus cost of living increases. Well, that applies here. We do the reduction, we calculate your retirement, that's what it's going to be. And then, should you die in retirement before your beneficiary, they receive a 100% monthly continuance for the rest of their life. Alternatively, if your beneficiary dies before you do, we don't increase your retirement allowance. Okay, so your retirement allowance stays the same for the rest of your life because we've already calculated it. So that is something to just note here. Let's see. One final note on option two is that based on some IRS rules, if your beneficiary is not your spouse and they are more than 10 years younger than you, there is a table of reductions from 100% that we are allowed to give to the beneficiary. So there's more information on that out at our on our retire page at sarah.org/retire, and it actually links to the IRS page that has those reductions. But like, let's say that your beneficiary is 11 years younger than you and they're not your spouse. Well, you might only be able to pay them 99% continuance, for example. So that's kind of how that works. The younger they get, the less it is, less than the 100%. Okay, option number 3 is the exact same as option 2, except the percentage is different. Your beneficiary, instead of receiving 100% continuance of whatever your retirement allowance was when you died, they're going to get 50% of that amount for the rest of their life. Okay, you can still name anyone for a lifetime continuance. And you'll note that one of the things that this does is, because the reduction is still based on the beneficiary's life expectancy, but we're paying them less, we're going to pay you more as an Sarah retiree. So for your retirement allowance, Option 3 pays you more than option 2 because we're paying the beneficiary less. We expect to pay the beneficiary less. Otherwise, it's the exact same as option 2. It's just a 50% continuance to your beneficiary. Option number 4 gives you a lot of latitude to choose exactly what your beneficiary is going to get. Okay, so this does a number of different things. Option number 4 allows you to specify a specific amount or a specific percentage to one or more beneficiaries for a lifetime continuance. So you can do a lot of different combinations here. Let me give you some examples. Let's say that you go to retire and you have a nephew and a niece that you want to leave a lifetime continuance to. Okay. So let's just stick with the nephew for now. You have one nephew you want to leave a lifetime continuance to. Well, you can't do that with the unmodified option. That they're not on the list here. Okay. And then you go to option number 2 and you're thinking, okay, I can leave them 100% continuous. That's pretty good. But then you look at the estimate for your retirement allowance and the reduction is too much. Doesn't pay you enough to live. And in fact, option 3 doesn't pay you enough to live. So you move on to option 4. You think, okay, I don't want to leave them 100% or 50%, but I could leave them another percentage, like 20%. So you could leave a 20% continuance, 10% continuance, or you could specify a dollar amount. You want to leave a $100 continuance. So you can do that. Or if you have a nephew and a niece, you can name more than one person for a lifetime continuance, and you can't do that with any of the other options. So you could leave them each 10%. So they could get 10%, 10%. So they would basically combined be getting 20% continuance at whatever your retirement allowance was when you passed away. Or if, somebody deserves more than the other, you could leave one 20% and one 10%. So it's all up to you what combination that you want to do. All of the other same rules apply as options 2 and 3. It's just you have a lot more, different combinations that you could do. Okay. So I gave you the rules, but what about the amounts? How much are each one of these options going to pay me when I retire is probably your question. Well, you can figure this out for yourself by, again, going and using our benefit estimator in your account. This time, pay special attention to the beneficiary fields here, okay? Because you're going to want to put in the name of your beneficiary, the relationship, and the date of birth. You may find that when you get here and you click on this drop down, if you've already named a NESARA beneficiary, which you should be doing, by the way, as a side note, for active death benefits, which means if you die before you retire, you should have a beneficiary on file with us. And if you log into your account and you go to the beneficiary page and there's nobody in there, go ahead and name a beneficiary so that we know who to pay if you should die before you retire. Or if you get in there and you find it's your spouse from 3 spouses ago, you're going to want to go ahead and update your beneficiary. And you can do that. There's a link on the beneficiary page that has your beneficiaries listed out in your account. Okay, but back to this. You click on the drop down, you select your beneficiary that may, perhaps it's your spouse. Make sure that the date of birth is correct, because if the date of birth is incorrect, and a few of them are, it's going to throw off the numbers. You hit get estimate. You end up with this PDF retirement benefit estimate. Now, when we zoom in and take a look at the different numbers, you can see that maybe you understand a little bit more about what each of these options do. You'll note some things. You'll note that the unmodified option pays the most of any of the different benefits. And this column is your retirement allowance. This column is what your beneficiary would receive in a continuance after your death. You'll note that the beneficiary amount is 60% of the unmodified option. You'll note that the option number 1 is going to be slightly less. In this example, I think it's $7 less than the unmodified option. You'll note that option number 2, the retirement allowance that is estimated to be paid to you is the exact same as what your beneficiary would receive after you die, because it pays 100% to your beneficiary. So, all of the different caveats start to fall into place here. You'll notice option number 3, beneficiary continuance amount is 50%. And you'll notice option 3 pays more than option 2. just like I told you. You will also notice there is no estimate for option 4 because there are way too many different permutations of what you can do with option 4 for us to program it into the calculator. So if you want an estimate for a scenario for option 4, you would want to get with your ready to retire counselor during your ready to retire counseling appointment. Okay, let me go to some questions that are up on the board here. Question is, how do you get to the table listing the amount or number of vacation weeks you have already sold back? Oh, that one's easy. And I'll just show you the screenshot here. You log into your account on our website, semianr.org/login, or just go to semianr.org, press the login button, click on the estimate a benefit option in the menu, fill out the benefit estimator, hit get estimate, and you will get this PDF. And what I'm showing you here in the screenshot is just the first page. Pages 2 through 4 or 5 will be all of your pay periods listed out that it's using to calculate this retirement benefit estimate. And then that's where you can see all of the vacation weeks that you've already sold back that are already being included in the estimate. Next question. I currently work for another agency and have reciprocity. Okay, we're saving that one. Okay, next question. So at a mid-career retirement seminar you went to 10 years ago, you thought you heard that if you die before you take your retirement, your spouse does not get the guaranteed monthly pension benefit. Is that true? Can you say exactly what they do get in that situation where you haven't formally retired? What will happen is, as long as you are already vested, so you already have 5 years of service credit, they will be offered 3 different options, and 2 of those options will come with a monthly benefit that they will get every month for the rest of their life if it's your spouse. And the option that pays the most is option number 2. And you can read all about these. I'll type it in at semianr.org/death. And the category is active member death benefits. And what would happen is that we would calculate your retirement as if you retired on your date of death, and then your spouse would get basically the unmodified option. So they would get 60% for the rest of their life. Okay, next question. On the lump sum payment, what's included in that? Your contributions plus interest. Oh yeah, and don't worry if you missed it. Yeah, so if there's still a balance of your contribution account for the lump sum payment, if we haven't already exhausted that account by paying you 3 to 5 years worth of pension payments, then there would still be a balance that would be returned in the lump sum payment. Also, if you die, let's say on the 15th of the month, that's 15 days of retirement allowance that we owe you. So we would pay that to your beneficiary. So the partial month payment. If you enroll in our healthcare plans, you pay those in advance, the premiums a month in advance. So we would refund the month in advance to your beneficiary. There's a $1,000 lump sum death benefit. There may be one that I'm forgetting. But that would be basically all of the lump sum payments that would still be there to be paid out. Yep, that's it. Okay, so understanding other benefits. Let's see, we have about 20 minutes before the deferred compensation presentation starts at 12:15, but it usually takes maybe 25 minutes to do the medical dental vision. I'll try to be efficient so that we don't go too far into the deferred comp presentation and I don't keep you too late if you don't want to, if you weren't planning on being here much past 12:15, but let's jump right in. Okay, so you've heard a number of different times in this webinar about guaranteed benefits, also known as vested benefits, which include the retirement allowance, the cost of living increase, and the $1,000 lump sum death benefit. And then, pretty much the different payment options that come with the different, retirement allowance options that you selected, the different death benefits, those would be considered vested too, because they're part of, the whole system. Now we have a set of non-guaranteed benefits here, non-vested benefits. These are extra benefits that the County of Alameda decided back in the 1980s that their retirees needed an extra set of benefits to help pay for their life in retirement. And so they started a reserve fund that ACERA runs. Our board runs this, our board of retirement. It's called the Supplemental Retiree Benefits Reserve. And there's a big pool of money in there. There's over $1 billion in there currently that is used to provide these extra benefits to you all as retirees if you qualify for them. Now, the board's goal is to keep this fund sustainable for the future so they can continue to pay out these benefits forever, or as long as possible, as long as there's money in there. So they're wanting to stretch out how long the fund stays sustainable. Currently, it's at the highest sustainability level it's ever been since the mid 2000s, at least, possibly before that. So currently there's a lot of money in there. But the board, in order to maintain fund sustainability, they set rules on who is able to access the benefits. And that's what you're seeing here. You're seeing a chart of the years of ACERA service credit you need to qualify to get these benefits, okay? And what you're seeing is a list of the non-guaranteed benefits, and there's 5. There is the monthly medical allowance, which is what MMA stands for. It's a medical subsidy that helps cover the cost of being enrolled in ACERA's medical plans. And there's 3 levels of it that have 3 different amounts of ACERA service credit you need to qualify. Take note, it says years of ACERA service credit. So this goes to answer that question that's been up on the board for a little while, which is, if you work for another agency, you have reciprocity with Alameda County, can you get medical benefits from here, the other agency, or Alameda County? Well, as long as you have at least 10 years of ACERA service credit, you could get a subsidy for our medical plans and dental and vision plans and for being enrolled in Medicare. If you don't have 10 years of ACERA service credit, you can still enroll in our plans. There's just no subsidy for you. And so that you would want to, run the numbers on that to see what's the cheapest option for you, whether it's here or over at the reciprocal agency, depending on what benefits they offer. Okay, now going back to this, with the medical subsidy, the dental subsidy, and vision subsidy pays 100% of the cost of being enrolled in those plans. The medical doesn't. I'll talk about that in a minute. Medicare subsidy is to help you cover the cost of being enrolled in Medicare through the federal government, because it comes with a cost that you have to pay to the federal government. Supplemental cost of living adjustment is an extra non-guaranteed cost of living adjustment that's paid on top of the vested one, the other guaranteed one. That helps you maintain your buying power. So let me just tell you about each one of these in more detail, because I have slides on each one of these. First off, I'll start with the monthly medical allowance. So when you stop working here at your job and you retire, you will not be able to maintain your enrollment in your employer's health plans for very long. There is COBRA, you could stay on them, but you may not want to because it can be expensive. So ACERA offers medical plans, dental plans, and vision plans that you can enroll in so that you can have healthcare coverage while you're a retiree. And if you qualify, you can get subsidies for those. Okay, so for the first one, the monthly medical allowance, you can enroll in a plan through ACERA, and if you have at least 10 years of ACERA service credit, you are eligible for the first level of the monthly medical allowance, which is the name of our medical subsidy. Again, it's not a guaranteed benefit. It only offsets the cost of ACERA-sponsored medical plans. So you can't go out and get an outside plan and expect to use MMA dollars for that. It's only our medical plan options. We do have group plan options and individual plan options. If you take a group plan option, it will help you cover the cost of the monthly premiums. The monthly premium is the monthly cost that you pay, that is paid to the insurance company to be enrolled in the plan. For the individual plans, it not only pays premiums, but also co-pays and deductibles if you happen to be in a deductible plan. The amount is set annually by Acera's Board of Retirement in order to maintain the sustainability of the reserve fund that pays for all these. You are responsible for any cost exceeding the monthly medical allowance amount. And I will tell you that unless you're Medicare eligible at age 65, if you're younger than that, the monthly medical allowance does not pay the full cost of any of our medical plans. So you would end up paying an additional cost from your retirement check. The medical subsidy, the monthly medical allowance, is not available to subsidize your beneficiaries, survivors, former spouses, dependents, plus ones, family members. It only goes to subsidize the cost of your medical coverage. Now, you can enroll plus ones and family members just like you can while you're, in your working plan, but there's no subsidy for them. But they do get whatever the price of the plan is that we offer. Okay, so here are the amounts that we subsidize through the monthly medical allowance for our medical plans for the year 2024. So this is the upcoming year. You can see that if you have at least 10 years of Acera service credit, you would be eligible for $317 and change per month. If you have at least 15 years, you'd be eligible for $476 and change. 20 or more years, you would be eligible for $635 and change. So I'm going to show you the slides next that show you the premiums for our current plans for 2024. So you can think about which monthly medical allowance amount you will be eligible for, if any, and you can compare that with the cost of the plans to get an understanding of how much of the cost these are going to cover. So just to show you, just giving you an overview of the plan offerings that we have for medical coverage, there are two categories here based on whether you're eligible for Medicare or not. If you are eligible for Medicare, which means that you're age 65 or older, or that there's other qualifying health conditions that get you eligible earlier, you would be looking at these plan options. And if you don't know what Medicare is the federal government's basically health insurance system in the US. Okay, so non-Medicare eligible, under age 65, you would be looking at these plan options. So you can see that there's three companies here: Kaiser Permanente, United Healthcare, and then individual plans through via benefits. So what I'm going to do, I'll show you the costs for the non-Medicare eligible group plans, Kaiser and United Healthcare. I'll show you the cost for the Medicare eligible Kaiser group plan. And then we'll talk about the individual plan options through via benefits, whether you're not Medicare eligible or Medicare eligible together, because it's more efficient that way. Just to note, our open enrollment every year is November. So the entire month of November is our open enrollment. So we have a long open enrollment. And that's your annual option to make changes to your healthcare plan, similar to what you would do while you're an active employee. Now, you don't have to wait for November to get into our healthcare plans, because retiring is a qualifying event to get right into our healthcare plans. We will get you right into medical, dental, and vision without a gap in coverage. And your counselor will help you through that and get enrolled in those. We do publish an enrollment guide every year that has all of the full details of the plans. This is our 2024 guide. The shortcut to get to it is to go to acera.org/guide. And this is a 36-page PDF, but in retirement, you'll receive this in the mail every year. Okay, so here are the non-Medicare group plan costs. So these are the 3 group plans that Acera has contracts with. You'll notice that they're the same as the counties, because the county actually, for our non-Medicare plans, they negotiate the contracts, so they're the exact same plans. And the premiums are all the same. So for the Kaiser Permanente HMO, you'll see that the self-premium is $1,037 and change. Signature value HMO through United Healthcare, a little more expensive. Signature value Advantage HMO through United Healthcare, a little bit cheaper than even the Kaiser plan. And in fact, it's about 8% cheaper than the Kaiser plan. So that's definitely something to consider if you are in Kaiser as an actively working member, but you may want to transition over to United Healthcare Signature Value Advantage because it's a little bit cheaper, depending on what your financial situation is going to be. You have to live, these are for California service areas because they're group plans, negotiated group plans. The service areas are the Bay Area, Sacramento, Fresno, Southern California, all over. And for Kaiser, I think they also have Santa Cruz. And so if you don't live in the service areas, then you can't enroll in one of these plans. You're going to be looking at individual plan options through Via Benefits. Now, one thing I want to note at this point is how the costs are paid. The premiums are paid to the insurance companies in the group plans, and how the monthly medical allowance is paid to you. So you'll note that, let's say that you enroll in the Kaiser Permanente HMO plan and you're not yet 65. That's why you're enrolling in this one. So what you're seeing here is a very crude illustration, simplified illustration of your check stub from Acera. You're going to get paid your retirement check from Acera. You're going to get a check stub. This represents your gross pay in this example. And you'll see in the deductions column an amount coming out for whatever healthcare plans you enroll in. So in this instance, they've enrolled in Kaiser HMO. In the additions column, you'll see any subsidies that you're eligible for that we pay to you. In this instance, they are getting paid the 20-year monthly medical allowance. And then so their net pay, they end up paying the difference. Now there's going to be on your real check, there's going to be other deductions, including tax withholding, because you're going to owe income taxes on your payments from Acera because you didn't pay income taxes on the money going in. So you're going to have to pay income taxes on disbursements going out. One thing I will note is that all of the subsidies that we pay are not taxable income. We have an agreement with the IRS. This is not taxable income. Okay, so what you saw on the previous slide, these are the non-Medicare group plan options if you're not yet Medicare eligible. If you are Medicare eligible, your one group plan option will be through Kaiser Permanente. What you have to do is you have to enroll in Medicare first, Medicare Parts A and B. You got to live in the service area for this plan, which are the same ones I just listed out. And then what happens is you get part of your coverage through Medicare and part through Kaiser, but Kaiser really handles the whole thing. So Medicare just pays Kaiser directly. And because the federal government is paying most of the cost, the plan is way cheaper than the non-Medicare plans. And what you get is a higher level of coverage than you would get through just Medicare alone. So you can see that the premium is $354.31. And what that means is that as long as you have at least 15 years of Acera service credit, it costs you $0 out of pocket to enroll in this plan. So you might as well. What I'm showing you here is an illustration of the 20-year monthly medical allowance. And so you get the premium, you got the monthly medical allowance if you are eligible for the 20-year one, and then you subtract them and you get the cost to you. Subtract the subsidy from the cost, and that's your out-of-pocket cost per month. And you'll notice that $354.31 is not one of the monthly medical allowance amounts that I showed you. $354.31 is not anywhere on here. The reason for that is because one of the rules of the monthly medical allowance is that it only pays up to the amount of the group premium. You do not get to keep the change. But the good news is that in that scenario, if you have at least 15 years of Acera service credit, the out-of-pocket cost is $0. If you have 10 years of Acera service credit, the out-of-pocket cost is, I don't know, like $25, $30. It's pretty cheap. Okay. So those are the group plan options. Let me tell you about the individual plan options through this company called Via Benefits. So the easiest question to start off with is who can actually enroll in one of these individual plans through Via Benefits? So if you are not yet Medicare eligible, which means you're under age 65, you can enroll in an individual plan through Via Benefits if you live inside the US, but outside Acera group plan service areas. So you can't live in the Bay Area, Sacramento area, Fresno, and it's all by zip code, Southern California, or Santa Cruz. If you go up and live in Redding, that's fine. Then you can pick an individual plan. through VIA benefits. You go to live in Nevada or Georgia or Florida or Hawaii, whatever, you can get an individual plan through VIA benefits. Now, if you're Medicare eligible, all you need to do to be able to enroll is live inside the US, and you just have to maintain enrollment in Medicare Part A and B through the federal government. So you can live in the Kaiser service area. We don't care. You could live in San Leandro or Oakland, and you're Medicare eligible, you can enroll in an individual plan through VIA benefits. And if you happen to like United Healthcare, there are United Healthcare plans, individual plans that you can get through VIA benefits. Okay, so more on VIA benefits is that it is a private health insurance exchange. They're basically a giant insurance broker. They have contracts with 100 different insurance carriers, and we hire them to match you with the plan that's right for you. And they have thousands of different plan options available. In any one particular area, there might not be thousands of plan options. It depends on where you live. But what happens is when it comes time for you to enroll in one of these plans, you contact them. You can do it by telephone or you can do it online. And you will be helped by a certified salaried non-commissioned benefit advisor. So I say that because they don't get paid more to put you in United Healthcare versus Blue Cross. They don't care about that. They're just getting a salary. What they will do is narrow down all the plans to what's right for you. So you show up on that call or over online with information, where you live or where you're going to live, what you can, how much you want to spend, how much coverage you want, like what level of coverage you want. You could even get as granular as what doctors you want to visit. If you have particular doctors you like, what prescription drugs you need, you can give them all that information. They'll narrow their 1,000 plans down to just a few, and you can choose among those. They can even send you more information on the ones that they narrow it down to. In this case, the monthly medical allowance for the individual plans not only pays for premiums, but it can also pay for deductibles and copays. Now, the monthly medical allowance, if you're eligible for it, is not put into your pension check, because we can't do that, and we can't take the premium amount out of your pension check because like I said, there's 100 different carriers that we would be dealing with. But that's what we hire, part of what we hire VIA benefits to do. So here's how this works. You enroll in an individual insurance plan through VIA benefits, and you are eligible for the monthly medical allowance, let's say. So a Sarah will take your monthly medical allowance dollars, and they'll send them over to VIA benefits, and VIA benefits will deposit them in a health reimbursement account for you, which is what HRA stands for. Okay, now then here's your bank account. So you enroll in the healthcare insurance plan, and you're going to owe a monthly amount called the premium to the insurance company. You pay them. You can set that up to happen automatically every month, so you don't have to think about it. Okay, you're out some money now, though. Okay, then now you have insurance. You go out to visit the doctor. There's a copay. You pay the doctor. You're out some more money. What you do is you submit reimbursement claims back through VIA benefits through their app, and they will reimburse you your monthly medical allowance dollars to your bank account. And you can set everything up electronically with them, and they will walk you through that. And so things happen automatically, and the auto reimbursements, auto payments, all of that, they have all that. Okay, now one more thing I want to point out about VIA benefits is that if you are Medicare eligible, so you're age 65 or older, and you're choosing an individual plan through VIA benefits, because those plans are so incredibly inexpensive, our board of retirement has decided that there's a slightly less, they will make a set of monthly medical allowance amounts that are slightly less for people in that category. And that's what you're seeing here. So you're seeing that it's a little bit less, but what they do is they monitor this and they make sure that this money is adequate for most people to pay their health expenses. And what they find when they measure this every year is that 90% of the people don't run out of the monthly medical allowance dollars. So because the plans are so cheap. Okay, let me see if there's any medical questions before I move on to dental. And Gene, I see you out there. I'm going to run into your time a little bit because we still got to do dental, vision, supplemental COLA, and that's about it. But I'll try to make it efficient. Okay, let's see. There's a questions out here. Okay, there's a question about Social Security penalty if you have a pension. The only reason that you would incur that penalty, and it's called the windfall elimination provision, is if you're not part of the Social Security system. Or you're not paying into the Social Security system for most of your career. And the people who generally are in that category are safety members. So you're going to want to go ahead and Google windfall elimination provision. And Social Security, whatever Social Security you're eligible for, might pay you less in that case. We don't have any information about that on our website right now, but there's lots of information on Google. So it's called the windfall elimination provision. All the general members, that does not apply to you. Okay, next question. Do the medical benefits stop when I turn 65? And am I eligible for Medicare? No, the medical benefits don't stop. You have the opportunity to choose a Medicare, what is called a Medicare Advantage plan or a Medigap plan. There's two different kinds. And that combines with Medicare to give you a higher level of coverage. So that's what I was just explaining there with the Kaiser Permanente Senior Advantage Medicare plan and then the Via Benefits Medicare plans. They combine with Medicare to give you higher coverage. Next question. If I don't pick a SARA for medical benefits at the time of retirement because I'm using my spouse's, can I still pick a SARA's medical benefit down the line when I no longer have the medical benefit from my spouse? Absolutely. And in fact, in most cases, you losing that medical benefit from your spouse, whether it's through your spouse retiring from their job or, whatever other reason that you're losing the medical benefit, that's a qualifying event. And we will get you right into an ACERA plan within 30 days. And we can make it so you have no gap in coverage, but you have 30 days to get that going after the qualifying event. And is the VIA benefit reimbursement taxable as income? It is not, because it is our monthly medical allowance, and none of those subsidies are taxable. Okay, dental. If you have at least 10 years of a SARA service credit when you retire, you must participate in one of our two dental plans, but it doesn't cost you anything. The self-premium and the subsidy are the same. So if you pick Delta Dental PPO and you have at least 10 years of a SARA service credit or a service-connected disability, you'll see 5105 come out of your check. You'll see 5105 go back into your check. The part coming out is us sending that money over to Delta Dental for you. And any of the premiums we take out of your check, we send it over to the insurance company for you as a courtesy to you. And then you'll see the subsidy coming back into your check. Now you can enroll Self Plus One and you'll just pay the difference. Or family, you'll just pay the difference. If you don't have 10 years of a SARA service credit when you retire, but you want to participate in the dental plan, you can voluntarily enroll, and there's a different set of premiums, and you just have to pay your whole way. Delta Dental PPO is a nationwide plan. So if you're going to live outside of California, you would probably want to choose that one. Vision plans, same idea. 10 or more years of a SARA service credit, you have to at least have the VSP standard plan, but it doesn't cost you anything. And you can buy up into the premium plan and you just pay the difference between the premiums. The subsidy is always going to be whatever the self-premium of the standard plan is. And again, if you don't have 10 years of a SARA service credit, you can voluntarily enroll in the vision plan. And like I said, all the details of what the plans cover, that's in our enrollment guide at acera.org/guide. Next non-guaranteed benefit I want to talk about is helping you cover the cost of being enrolled in Medicare. What happens is you turn 65, you've paid into the Medicare system throughout your whole life, or maybe you haven't. I'll talk about both scenarios. If you've paid into Medicare throughout your career for at least 10 years, you're eligible for Medicare. Part A is free. Part A is hospitalization. Part B, which is doctor's visits, comes with a cost. The federal government will start charging you a monthly amount. Well, it'll actually be charged quarterly if you're not yet taking Social Security. It'll come out of your Social Security check if you are taking Social Security. But the dollar amount for 2023, for example, at the base level is $164.90 per month that it will cost you to be enrolled in Medicare Part B. Now, as Sarah's board knows this, they don't want to disincentivize you from enrolling in Medicare, because when you enroll in Medicare, it's way cheaper to have the healthcare plans that work with Medicare. So they will cover the cost of the lowest level of your cost of being enrolled in Medicare Part B. And when I say the lowest level, there is a income-related adjustment. If you have higher incomes, you might have to pay more to Medicare, but the Medicare Part B reimbursement stays the same at the lowest level. But the incomes are actually pretty high, and you can find those listed out on Medicare's page. And you don't have to do anything besides these three things. The first thing is that you have to have at least 10 years of a SARA service credit or a service-connected disability retirement, number one. Number two, you just got to enroll in Medicare. You maintain enrollment in Medicare Part A and B. Number three, you just enroll in this one time to a SARA. You submit the Medicare Part B reimbursement form to a SARA at the time that you become Medicare eligible. We will enroll you in this, and you'll start seeing $164.90 show up in your pension check or whatever it is, because it goes up and up and up every year whenever Medicare increases their costs for Medicare Part B. Now, for the people who are perhaps safety members who have not paid in the Medicare system for at least 10 years, you can still enroll in Medicare. Everyone can enroll in Medicare at age 65. It's just that you will probably incur a cost for Medicare Part A as well. And so you would just have to see what the cost is for that. The final non-guaranteed benefit that I'll talk about is the supplemental cost of living adjustment. This keeps you at 85% of your original purchasing power that you enjoyed at the time of retirement. So what happens is you retire, inflation starts happening. You start getting your retirement allowance, but inflation starts happening, prices go up. If you lose more than 15% of your buying power, like let's say 10 years after your retirement, the supplemental cost of living kicks in and it keeps you at 85% of your original buying power. And you'll never receive less than 185% of your original buying power. This benefit is amazing, I think. And whenever we survey members, this is the second most popular benefit, because you cannot lose more than 15% of your buying power to inflation at any point for the rest of your life. Okay, really quickly, I'll kind of let you review this slide on your own because I want to make sure to save time for the 457B presentation. But there are some life events that don't necessarily apply to everyone, but I just want you to know that we have information about these events out on our website, and all of the links are here. And if you want to download this presentation, all you do is you go out to our seminars page, you type in acera.org/seminar, seminars, or you go under news and events, retirement planning seminars. I've showed you this a few times by now. And you just scroll down to pre-retirement, sorry, let it load. Pre-retirement webinar slides are right here. Now, after this, wait like 15 minutes because I made a few updates, and I'm going to upload the new one about 15 minutes after the presentation ends. So wait for that. But these slides are all available out on the website, or the updated ones will be available. If you are planning to defer your retirement, which means not retire immediately, if you want to learn more about our death benefits, if divorce might be in the cards for you in the future, or domestic partnership dissolution, if you are possibly going to apply for disability retirement, if you're planning on working after retirement for one of our 6 participating employers, go to this page, acera.org/working, because there's some rules around that. And if you're planning on relocating after retirement, just change your address with us. So if any of these things apply to you, go out and find that information out on our website. And always, if you have questions, we are here to answer your questions. We have counselors waiting to talk to you. So you can call us, you can email us. Okay, so without further ado, I'm going to turn it over to Jean Hilliard, who is going to present on the deferred compensation plan, and he is hired by the county to educate you all on this because the county runs a deferred compensation plan. If you don't work for the county, every one of our 6 employers offers a 457B account. You would just need to talk to whoever at your facility manages the 457B accounts. But all of this information that Gene is about to give you applies to all 6 of our employers anyway. So just hang around and see what he has to say on this. Gene, are you there?
I am here. How's it going, Mike?
Excellent. Going really good. Thanks for being
Good.
here.
Absolutely. Absolutely. It's my pleasure. Let's see. Let me go ahead and share.
And there's a few questions I see popped up. I'll type in the answers to those. So
Okay,
Gene, get
great.
started.
All right, let's see. Let me change this. Here we go. I think that should be perfect.
Oh, we're
Well,
seeing your notes.
you see my notes.
We're
All
seeing your
right. Let me.
presentation notes.
All right. How's that?
There we go.
All right,
All right,
perfect.
take it away.
All right. Thank you. Well, good afternoon, everyone. My name is Gene Hilliard. I'm Vice President, Financial Advisor of Emerge Financial Group. We're a financial services firm in Oakland. We help our clients with retirement planning. We help our clients with taxes, preparing taxes, tax returns, and we do accounting for small businesses. Um, my firm was hired roughly 14 years ago, at the time by Prudential Retirement. We were hired to provide retirement planning, investment advice, and education to county employees. So it's a pleasure and an honor to be able to present to you guys today a little bit about my background. I'm a licensed independent financial consultant slash stockbroker. I've been licensed roughly 20 years, helping my clients create wealth, maintain that wealth throughout their lifetime of their children and grandchildren. And I'm also a retirement counselor. And my goal as a retirement counselor is to help each and every one of you maintain your current lifestyle, right? My goal is to help you the exact same paycheck you're getting today. I want you to get that paycheck in the future. So that's kind of my expertise. And one of the best ways to make that happen is to invest in the deferred compensation plan. But for today's presentation, unlike the last couple of days where I dove into details about deferred comp, my goal today is to help each and every one of you determine whether or not you're ready for retirement, right? Or what you should be thinking about in retirement. So that's what I'm going to go through for roughly the next 30, 45 minutes. So I would love for each and every one of you to stay on this call or continue to watch the video, and then I'm available to answer questions after we're done. So, what is retirement readiness? These are your determining factors. And I think Mike did a great job of talking about some of those determining factors, such as Social Security, right? How much am I going to get? When is the best time for me to collect it? Your pension benefits through ACERA. How much am I going to get at variety of different ages? Your retirement plan with deferred comp. What are the rules around that? How much can I take out? How much is appropriate to take out of my retirement plans in order to avoid running out of money? Retirement income, healthcare costs, and one of the biggest factors I really want you guys to really give some thought to prior to retirement is your emotional readiness, right? You spent 40, 50, 60 years getting up, going to work. That was your routine, and that routine is going to go away. So what do you have in place to supplement yourself in terms of a routine? And I'm going to talk a little bit about that later in the presentation. Okay, so let's take a closer look at retirement ready. These are On the left-hand side, we're talking about the big picture items, right? Retirement income, Social Security, healthcare costs, retirement, your budget, psychological effects. And then I'm going to also dive in a little bit of details in terms of investment principles. What's the best way to invest? Your withdrawal strategy. Should I take out a specific amount, a percent of my deferred comp account or 401k or whatever investment retirement plans you have? Taxes, how does that factor in? Inflation, where is the best place to live? Should I stay in California? Should I move down south where the cost of living is a little bit lower? And at the end, I'm going to talk a little bit about estate planning and a long-term care. Not going to spend a lot of time on that. Just want to just kind of give you some food for thought. Okay, so let's talk about retirement income. Where will your income come from? Right? Most financial planners say you're going to need roughly 70 to 90%. Most guys and gals will say 80%. You need 80% of your pre-retirement income in retirement. Now, some of you may be thinking, well, why not 100% of my salary? But here's what I want you guys to keep in mind. There is a lot of costs that go away when you retire. For example, do you have to pay into a SARA when you retire? The answer is no. If you're contributing to deferred comp, will you continue to make contributions to deferred comp when you retire? And the answer is no, because you can't, right? Number three, will you have to continue to pay into Social Security when you retire? And the answer is no. So those are three big ticket items that go away in retirement. So in many cases, you don't need 100%. But I often say, let's shoot for 100%. And if we need to settle for 80, settle for 90, settle for 70, then so be it. But let's shoot for it. Hey, more is better, right? Where is your income going to come from? Well, it's going to come from Social Security. So make sure you go to ssa.gov to see roughly how much you should anticipate. Pension, log on to wasera.org and use that calculator. You're going to probably have some income from assets, or maybe some of you, maybe you have investment properties, or maybe you have an investment accounts that's kicking off dividends, or you have some CDs that are retirement that you're going to get some interest. So there's some income from assets, or maybe you might want to work while you're retired, which I would encourage. Keep yourself sharp. I find it unacceptable for you having to work. But if you want to work, hey, there's nothing wrong with that. Okay. Do you have enough to retire? These are some of the questions you want to ask yourself. If, for example, today you were to just flat out stop working, can you sustain your lifestyle? Right? What do you anticipate your retirement expenses to look like in the future? You kind of, hey, crystal ball. Is the house paid off? Are the kids finally out of the house? What do your expenses look like? How much will healthcare be? That's a moving target. But you want to consider, the cost of healthcare. Do you plan on doing something on the side? Maybe coming back as a retired annuitant or working as a greeter at Walmart if you want to, right? Again, I encourage that, but that's something that you might want to consider during retirement. Okay. How and where do you want to live in retirement? I mentioned that before. Are you going to stay in California? Are you going to move to New York? Are you going to move to Texas, Georgia, right? Where the cost of living is a little bit lower. Those are some things that you really need to consider when you're determining whether or not you have enough for retirement. Okay. So let's assume, oh man, I don't know if I have enough. Well, here are the IRS limits. This is for 2024. If you are under 50 and and you want to make a maximum contribution, it's going to be 23,000 for 2024. Keep in mind that in 2023 it's 22,500, so it's going to move up by $500 for next year. And if you're 50 and over, the IRS will allow you to put away an additional 7,500. Okay, bringing your total to 30,500 that you can contribute to deferred comp. Right. So if you're running low in terms of retirement savings and you're not even close to this max, you might want to consider making an increase. So let's say hypothetically you have maxed out your deferred comp. Are there any other ways in which you can save? Well, there's an IRA. Now that's going to be outside the scope of deferred comp. You'd have to set up an IRA at the bank or at a brokerage company, and you can make a $6,500 contribution if you're under 50, an additional 1,000. Now, it may or may not be deductible with this IRA, right? It all depends on your income, your combined income or your single income in terms of being able to deduct that IRA. But it is available to you if you really want to put even more into retirement. There is another avenue in which a person can put away roughly $46,000 a year for 3 years, and that's called the 3-year catch up. Okay. The IRS would allow you to blow through that max, the normal max, and take advantage of the 3-year catch up where you can put away $46,000 a year only for 3 years. Now it's just the 46. You can do 46,000 plus the maximum of 30,500. It's just 46,000, but you have to qualify. How do I qualify, Gene? Well, you have to be, if you're a general member, you have to be at least 54 and a half. If you're safety, you have to be 40, I think it's 47. So it's 3 years away from normal county retirement. So 47 if you're safety, 54 for everyone else. But you have to qualify. How do you qualify? Well, the best thing to do is to reach out to Darnell Williams. So email darnell.williams@acgov.org. Just let them know, hey, I just sat through a presentation with Mike and Gene. I heard a little bit about the 3-year catch up. I want to know if I qualify. And the way it works is he would go through your records in terms of your payroll records to see if there were years in which you could have put money into deferred comp or more into deferred comp and didn't. And he just continues to add that up, and it's going to bring it to roughly 46,000. So most people, when they first start with the county, say for example, the max is 15,000. You're just starting with the county. You're not making a ton of money. You bypass deferred comp. Well, there's 15,000 you could have put in. So that's the process that he goes through throughout your career. Now, since I've been working with county employees, it's been roughly 14 years. I've run across 2 people who didn't qualify for deferred comp. And these are 2 people that have been maximum contributors from the day they were hired from deferred comp. And I don't know how in the world these people were able to do it. I didn't think there was a person like that exists with the county, but I found 2 that were max contributors into deferred comp for 30 years. So shocking, but I'm sure many of you probably will qualify. So if you got money sitting over at the credit union, not earning a whole heck of a lot, there's a way in which we can indirectly get that credit union money into deferred comp. But remember, the contributions that you make to deferred comp, it must be through payroll deductions, right? So typically the way in which you can get money from the outside into deferred comp is to have us withhold, and the maximum amount percentage that you can withhold out of your paycheck is 60%, roughly. Right. So you have to say, Gene, I want to increase my contributions to 60%. And then when your paycheck is short, you don't have enough money to pay your bills, then that's where you go to the credit union or you go to that side account to pay your bills. And then once your that savings account dwindles down to a number you feel comfortable with, then you can just go back to the standard amount that you were doing prior to the catch up. Okay. to get a good feel for where you stand, there's a couple of great websites that you can go to. Empower has a great website, retirement income calculator, where you tell you tell us we already know how much you're contributing to deferred comp, but you put in any other assets that you have earmarked for towards retirement. You also will need to put in the amount in which you expect to receive from a SARA into the system, and then the retirement income calculator will spit out whether or not you have enough money to save towards retirement. Okay. Social Security. Let's talk about Social Security briefly from a 30,000 foot level. Not going to go into a ton of detail, but many of you are aware of how Social Security works. You're paying Social Security tax, you're paying, your employer's paying, is going into an account, you're creating income that you can never outlive. And there's about three different ages, roughly, that you can begin receiving your benefits. It's 62, it's 66 or 67, or as late as 70. Doesn't make any sense to wait past 70 to collect Social Security because you're not going to get any more money. But as the longer you wait to contribute to deferred comp, or I'm sorry, the longer you wait to collect your Social Security benefit, the more you get as a monthly payment. Okay. The longer you wait, the more you get. Okay. Here's a hypothetical example of a person who, at variety of ages, average annual salaries 25,000, person can expect at full retirement 1,200, and a person who's making roughly 142,000 and up can expect to receive $3,338. Okay. Now you're probably thinking, hey, there's no way I can sustain my lifestyle with this amount of money. Well, the good news, you work for the county. So you're going to get a SARA and your Social Security. But even sometimes when you combine those two, that's still not going to be enough. Many people come to me all the time to ask, when's the optimal time to collect Social Security? Right? And at the end of the day, it's all about life expectancy. How long do you anticipate living? Which none of us really know for certain. But this chart kind of illustrates if you were to live until you're 80 years old, to get the most bang for your buck is to collect it at full retirement. So 80 is $299,000 of benefits you could have received. If you were to make it to 85, to get the most bang for your buck is waiting until age 70. And the same holds true if you were to make it to 90. The best time to collect it is age 70. But again, it all depends on your life expectancy, which we don't know. We have no control over. There was a time where I would always tell my clients that, you want to try to get the most bang for your buck. At a minimum, collect it at full retirement, right? But I've learned since COVID that tomorrow is not always promised, right? There's also three phases of retirement that I talk about. You have your go-go phase, your slow-go phase, and your no-go phase. And wouldn't it be a shame if you were waiting to age 70 to collect your Social Security and you're now in that slow-go or no-go stage where you can't enjoy your money? So there's trade-offs there. I would encourage, retire when you can, collect the money where you can, and enjoy your retirement and enjoy your life going forward. Mike talked a little bit about the windfall elimination period. There's a lot of folks that really get confused about that and they stress out about it. But at the end of the day, it's all about whether or not whether or not you've paid into Social Security at a variety of different occupations, right? So just ask yourself, go throughout your career, did you or did you not pay into Social Security? If you did, then this windfall elimination apply. But if by chance you worked in a government job where you did not pay into Social Security, whatever income that you received during that time period will in fact affect your Social Security. It's pretty much simple as that. But as Mike mentioned earlier, oftentimes it's just safety employees who do not pay into Social Security. Okay, so they're the ones who more than likely are going to be affected by the windfall elimination provision. Okay, let's talk about budgeting. Budgeting is extremely important. A lot of folks don't want to deal with it. It's like a four-letter word, but it's important, especially as you're nearing retirement and in retirement, because you cannot work overtime when you're retired to make ends meet. You have to live within your means. Okay. So the benefits of retirement budgeting is you're prioritizing your future spending. You're kind of getting a feel for what lies ahead in terms of your spending, right? It may help you, may help your retirement savings last longer because you've actually put pen to paper to see what can be cut. If you've determined there's some things that you can cut, that means that your retirement savings potentially could last longer. Okay. It might even help you reach your financial goals. Again, if you can cut some stuff on the front end, maybe you don't need as much in savings to cover your bills, and maybe you can retire sooner. Okay. What is the foundation of your retirement budget? It's looking at your current expenses, right? It always starts with what's going on now. I'm putting everything, all of my bills on an Excel spreadsheet or on a piece of paper, right? What are my fixed expenses? What are my variable expenses? We all kind of know what the difference is. I mean, your fixed expenses are expenses that don't go up, don't go down. They're pretty consistent. And oftentimes it's your mortgage payment or your rent in many cases. But then you have your variables, right? PG&E is a huge variable. It's often higher during the winter and lower during the summer in some cases, depending on where you live, right? Um, you want to you want to be honest about your needs and your wants. There's certain things that you need, and then there's wants on there that maybe you can put to the side. But if you do want some of these wants, you got to make sure you put some money away to cover those wants. Okay. What are your retirement expectations? What lifestyle do you anticipate living in retirement? Right? If you want to live a more luxurious lifestyle in retirement, then that's going to cost you more. So let's start putting some money away now in order to cover that. Okay. Here are some of the other items that tend to pop up that people really don't take into account. And home improvement's a big one. The roof is, you've had this roof for, I don't know, 25 years. It's a 30-year roof. You may need to replace it. Have you taken that into account in your retirement savings? Okay. Caring for aging parents, that's another big one, right? My mom's 80, and I recognize there is that possibility that she may need to come live with me. Am I prepared for that? Is the house in a position to care for my aging mother, whether it be walk-in tubs or it, those little um, chair lifts that you put on the stairs? Do I have enough money to cover that? Grandchildren, that's another big one. I just had a client who had to step in on behalf of their daughter to care for a grandchild that they were unexpecting, right? So those are some things that you want to think about and you want to consider when you're saving towards retirement. Emotional transition, you're going to go through a lot when you're in retirement that you may not even think about, right? It starts with your growing interest in retirement. You're excited. um, you've heard about people retiring. There's so many things that you want to do, right? So you have that interest. And then you have the initial euphoria. I can't wait. I'm going to take a vacation. I'm going to buy a brand new car. You're really excited. But then there's stress starts to kick in. Believe it or not, after that first year or two, the stress starts to kick in because and I mentioned this earlier, you've had a routine for 40, 50 years of getting up, going to work. It's just like clockwork. And then all of a sudden that goes away. So that creates some stress. But you will eventually adjust and then you'll settle down and hopefully you build your own retirement routine. These are some of the psychological effects that you may experience in retirement. Loss of identity, procrastination, that's a big one, right? Oh, I'm going to get up and go to the gym in the morning. I'm going to leave at 8 o'clock. And next thing you know, you're watching TV, you took a nap, and it's 5 o'clock. You've just procrastinated. I was supposed to go to the gym and I didn't go, right? I talked about lack of structure, a little bit of loneliness. Some people don't recognize the friends that they've made while they were working, and they've become almost family. And you don't get to experience that once you're retired because they're working, maybe, right? Depression sometimes kick in. Death anxiety is another big one because as you age, stuff start to hurt more and more and more. Your colleagues or friends from high school or whatever start to pass away. So you start to think about some of those things. So these are some of the psychological effects that you may have to deal with in retirement. How do you deal with it? How do you fulfill those emotional needs? Well, hey, let's get a hobby, right? Let's join a bicycle riding club is a big one, or uh, plant a garden. I know there's a lot of retirees that love gardening, pottery work, volunteer. Go down to your. I've had quite a few clients who live nearby an elementary school, and they're like a crossing guard. I'm telling you, those little tiny babies, those tiny kids, they really uplift you just looking at them, how happy they are, and how fulfilling that could be to help those kids. Okay, what I plan on doing when I retire, I'd say it was roughly 10 years ago. I was a court-appointed special advocate. I was a mentor to kids that are in foster care. That's an excellent volunteering uh, idea for many of you, and that's something I'm definitely going to go back to do once I'm retired. Part-time work, I always encourage doing a little part-time work to keep you sharp. Sports and activities, another important deal. Hit the gym, play some tennis. Uh, Join a bicycle club, right? Social engagement is another big one. I know there's tons of groups of retirees or retirement groups that are out there that, play cards on one day or everyone comes to their house to have dinner. Social engagement, getting around people, not staying indoors all the time, will really help fulfill those emotional needs. Okay. Withdrawal strategy. Hey, I got this $1 million, 500, $800,000. I got to make sure that I'm responsible with this money. So it's important that you come up with some sort of a withdrawal strategy. And I'm going to touch on a couple of withdrawal strategies that you may want to consider in retirement. But before I get to that, there are some factors that are just not in your control, right? Longevity. How long am I going to live? Investment returns. Can I expect to get 3%, 5%, 6%? What sort of rate of return am I going to need to ensure that my money doesn't run out? Inflation. Inflation for most of my career wasn't that big of a deal. It was 2.5%, 5%. But what we've experienced over the past year or so, hey, it could spike. I think inflation was up over 11% a couple of years ago. It's come down significantly through the Federal Reserve's taking the necessary steps to curb inflation. It's down to like 6 or 5. Still not where we want to be, but inflation will always rear its ugly head as you're nearing retirement and in retirement. Okay. And your future expenses. Again, we don't know what the future holds. So that's why it's important to put some money aside. Okay. Here's a withdrawal strategy some people use. Just pick a specific dollar amount, right? You know what your bills are, subtract out how much you're going to get from Social Security, subtract out how much you're going to get from a Sarah. Hey, I'm short 20 grand a year. You can pull that out of deferred comp. So we can give you the 20 grand a year, and then we'll increase it by whatever the inflation rate. So I'm using an example of 3%. Right? So you can use a constant dollar amount approach. You can use a constant percentage amount. Many financial planners say at least start with 4% of your retirement assets. If you can live off less, that's even better. But 4% is a good starting point. It's not the end all be all, but 4% is a good number. So take 4%, whatever your account balance is. That's how much you should take out per year, and then go from there. You're not increasing for inflation. You're just sticking to that percentage. Okay, that is a strategy that you can employ, and then if you need to drop it or even increase it, if you have to, then you can. But again, start with 4%. Another approach is called the required minimum distribution reports. Now, approach. Now, be aware that they've changed the rules where once you turn 73 and you're no longer working, you're required to take out a minimum amount, and it's based upon life expectancy tables. So you could use that approach in terms of pulling money out. Just grab the life expectancy table, do the math, and take out whatever is appropriate at that specific age going forward. So you're getting your income that you need, plus you're covering that required minimum distribution once you are somewhere north of 73. That RMD that I talked about, required minimum distribution, is extremely important, because if you don't pull that out on a consistent basis when you're supposed to, you could be hit with a penalty of 50% of what you should have taken out. And that's a big deal. Now, again, if you're still working for the county and you're 73 years old, you don't have to take money out of your deferred comp. But if you happen to have a 401k, a 403b at a previous employer, and you're 73, still working, you still have to take money out of those plans. So just keep that in mind. Okay. But if you're working for the county and you're 70 plus, you're not required to take that minimum out. And then there's the last method that some folks use. It's a little outdated, but you can just live off the interest of your account. Put your money in the stable value fund. It pays 2%. So you just live off the 2% that you're getting every year, or whatever the interest is. So you can do that. That's an approach that you might want to consider going forward. Reach out to me if and when the time comes and you need some help in determining which one of these methods is appropriate for you. That's what I'm here for. Okay. Taxes on retirement income. Just know that, hey, if you're investing in pre-tax money, you're investing pre-tax money into deferred comp or IRA or 401k or whatever, recognize that you're going to have to pay taxes when you withdraw it. How much is it? It's based upon how much income, how much your ACERA is, any other income that you're receiving in any given year. Okay, but Empower will automatically withhold 20% federal, 3% state on any disbursements, okay, out of your deferred comp. If you have invested in the Roth version of deferred comp, then there's no taxes on the disbursements, provided that you're at least 59 and a half and the account's been open for at least 5 years. Okay. Will my Social Security benefits be taxed? Well, it depends on how much income that you've received in any given year. So as this slide shows, if you're an individual and you're making $25,000 to $34,000 a year, up to 50% of your Social Security could be taxed. And if you're making more than 34,000, up to 85. Okay, so it all depends. Confirm with your CPA tax accountant in terms of the whether or not your Social Security will be taxed. This is just information that I've gathered, and it's at least the most recent research that I've been doing. I've been told that this is the amount of Social Security will be taxed, depending on your income. Okay, where's the good place to live? You're going to stay in the Bay. You're going to go to Georgia, New York, all depends. Deciding where to live it's really about more than just the weather. It's cost of living, quality of healthcare in the state or country, state taxes, distance from family. That's a big one. If you have grandchildren that are still here in the San Francisco Bay Area, 9 times out of 10, you're not going anywhere. Once you get your arm around your grandchild, the thought of having to leave or not be able to see them consistently is going to kill you. So you're probably going to stay in the Bay. So start putting some money away. Don't assume you're going to just run to Texas in a low-cost state. It's probably not going to happen. Okay. States with the best tax rate, if you have the flexibility of moving. You got Delaware, Hawaii, Wyoming, DC, Nevada. They have the best tax rates. Cost of living, you got Mississippi, Oklahoma, Arkansas, etc. Do you want to move over to Middle America? It's up to you. State with the best health care. California's number 4. It's just pricey, but we do have good health care. Okay. Where to live comes down to deciding what's important to you. So really make that decision on what's important to you and then act accordingly. Okay. Long-term care, I'm not going to spend a lot of time on long-term care. If you have a policy in place and you can still afford to make the premiums, stick with it, but read the fine print, because in many cases, the amount of money that you're going to get when the time comes, it's probably not going to cover a whole heck of a lot, especially if you stay in the Bay. Many plans say they'll pay you $200 a day for long-term care. And if you're dealing with long-term care in California, it could be three times that amount. Okay. I wouldn't even bother looking for a long-term care policy. Just self-insure. Put some money to the side in deferred comp or in an investment account and say, hey, I'm going to keep funding this account. And if and when the time comes, I'm going to use this account for my long-term care. Okay. These are the different common types of long-term care that you're going to have to be dealing with: homemaker service, adult daycare, assisted living facilities, nursing. Here's the average median rate. Hey, if you're going to stay in California, figure you're going to be paying triple these amounts. Okay. Medicare, Medicaid doesn't cover a whole lot in terms of long-term care. Covers a little bit, but it won't cover the bulk of what's going to be needed for long-term care. Okay, let's talk a little bit about estate planning. It's very, very important. Most people feel, hey, if I have a will, I'm good, I'm covered. Will's not enough. A will is still a probatable item, meaning your beneficiaries, your heirs would need to hire an attorney, sit before a judge to determine who should get their inheritance, right? And that could be 25% of whatever you've racked up and saved and you had planned to give to your heirs. So to avoid that, setting up a revocable trust is optimal. From what I understand, I believe the county employees have MetLife Legal, or there's some sort of a legal assistance that you can sign up for to hire an estate planning attorney. So I would certainly encourage that. Within the estate plan, you're still going to need a will, but you want to have a trust. You want to make end of life decisions or have it in writing. Who's going to take care of your child or grandchild if something were to unexpectedly happen to you? You don't want any fighting over kids, so that should be included in your estate plan. Okay, these are the different components. I talked about wills and trusts. Picking a trustee or an executor is also extremely important. So give that some significant thought. Okay, what's next? Well, take a deeper dive here. I talked about it earlier. Log on to acera.org to determine how much you should anticipate receiving from Acera. Get some details on Medicare. SSA.gov to determine how much you're going to get from Social Security at 62, 67, 70, right? IRS website. So take a look at these websites, do your homework, get ahead of the future. But I would obviously encourage you to, in terms of going back to the emotional needs, figure out what your passion is going to be in retirement before you retire. Extremely important. You have to fill that void before retirement. You don't want to wait until retirement to figure this stuff out. Have a plan beforehand. If you need some help with retirement planning across the board, Mark Tomei is still working with county employees, Jason Brummett, myself in the middle. We're here to help you in any way we can. Doesn't cost you anything. It's all built into the cost structure of the plan. To get in contact with us is this number, 855-969-4572, to schedule an appointment or log online to schedule an appointment. If you want to bypass this 855 number, you want to get a hold of me directly, feel free to call my office at 510 562 6355. That's 510 562 6355. Or you can email me at g_Hilliard, HILLIARD, at emergefinancial.com. Okay. Empower is the new third party administrator. They're a great company to work with. They have excellent tools. They have guidance counselors similar to myself that are willing to help you. They're even open on Saturdays from 6 to 2:30. So if you have some questions regarding retirement or you want to move some money around, etc., log online, talk to an Empower representative, and I'm sure they'll be able to take care of you. So with that, I would kind of sped through that because I know you guys are probably tired. So I'd love to entertain questions.
Awesome. Thank you so much, Gene. That was
Mhm.
fantastic.
My pleasure.